Good morning, everyone, and welcome to Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, PacWest has reignited fears around the banking crisis. Shares have plunged in after-hours trading after the California lender said it's in talks with potential investors as it weighs strategic options for its business, including a sale or fundraising round. Now, PacWest's turmoil, it comes despite Fed Chair Jerome Powell's assurance yesterday that the U.S. banking system is sound and resilient. Second thing you need to know, the Federal Reserve hiked interest rates again on Wednesday, bringing rates above 5% for the first time since 2007. In his press conference, Fed Chair Jerome Powell changed up his language from past meetings, signaling that it may now pause its streak of rate hikes, instead of saying that he anticipates the need to raise rates again. This change is not a tell-all of the Fed's next move, but does show signs of a slowdown on the horizon. And third thing you need to know, Qualcomm managed to meet earnings expectations in its first quarter, but its gloomy forecast stole investors' focus. The company's revenue forecast for the third quarter fell short, signaling that the demand for smartphones remains slow. Qualcomm CEO Cristiano Amon blamed the results on a tough environment, and the company says it has not seen a strong sales recovery in China.
And starting off with PacWest shares, they've been tumbling since the California lender said it's weighing strategic options for its business, including a possible sale or fundraising round. Now, this comes just after Fed Chair Jerome Powell made those assurances in that press conference that the banking sector is making positive strides.
I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
Joining us now to discuss is David Cheverini, Wedbush Securities Managing Director of Equity and Research. Good to have you on the show here. So trying to sort of gauge that sort of optimism, at least about financial stability from the Fed versus what we're still continuing to see here with PacWest. What are you making of this?
Yeah, so we're in an environment where investors are on edge. And when a company comes out and says that they're exploring strategic options, investors tend to think that that means things are not going well. Now, they added some clarification based on the story that was broke by a media outlet with a press release last night saying that deposits have been stable this week post First Republic, going into receivership and sale to JP Morgan. But looking at the first quarter numbers, PacWest was on the weaker end in terms of deposit outflows. They had deposits decline 17% in the first quarter. That was at the upper end of the peer group. And they also screened poorly on a tangible book value basis when taking into account the fair value marks. And those were the issues that basically took down Silicon Valley Bank and took down First Republic. And PacWest on that basis is only has $1 of tangible book value on a fair value basis as of 12/31. Now, interest rates have come down since then, so the 331 mark could be incrementally better. The 10Q hasn't come out yet, so we don't know what that number is, but that doesn't screen well for them. But what they have going for them is that since 12/31, their insured deposit level was 45%. They've improved that to 75%. So that should mitigate deposit outflows in this type of environment. Now, given that the stock is down significantly, the stock price action has become a factor in the way depositors think about their bank. So if they see their bank stocks is down significantly, that might spook them and lead to deposit outflows. But they're doing their best to try and calm their deposit base, and we'll see how that progresses.
David, what are some of the most important steps that regional banks can take right now to mitigate the risk of failure, if there is still a step that they can take?
Yeah, the main thing that some banks have been utilizing is this service called ICS, is Insured Cash Sweep. So it's a network of banks that come together and basically swap deposits with one another to increase the insured deposit level. And they can keep the deposit costs at the same rate. So basically, if a bank brings in an account that's above the 250K threshold, say it's $1 million at a deposit cost of say 3%, another bank with a similar deposit level, they can swap out deposits and open up additional accounts with each other to kind of circumvent that 250K deposit insurance cap. So that's what Western Alliance and PacWest and others are utilizing to increase their insured deposit base. And I'm expecting this service to essentially become table stakes for the industry because it's an easy way to increase the insured deposit level. Outside of that, the banks really have to just continue to execute the way they always do. Bringing up their capital levels is certainly going to become a focus of banks over the next few quarters. And PacWest is pretty much top of mind trying to get their capital ratios up. For instance, they were at 9.2% for their common equity tier 1 ratio at 331. They're looking to bring that up north of 10%, and they're doing that by selling some assets.
And even within the banks themselves, you also have this issue of some of this money going towards these money market funds as people are still chasing high yields. How does that play into the picture as well?
Yeah, that is proving to be potentially more fierce competition than the banks themselves, because the rates that you're getting on money market funds are approaching 5%, right in line with the Fed funds rate. And that is a very high level when you compare it to what depositors have been getting within the banking industry over the past several years, for that matter. So they need to try and compete with those money market funds by bringing up their own deposit rates. And that's putting pressure on their net interest margin. So it's not very good fundamentally for the banks for that to be happening, because as their net interest margins come down, then net interest income comes down. So it pressures their EPS.
David, in terms of the kind of chronological order that this is all taking place in, it's hard not to think back to the assets that JP Morgan was able to pick up, a large bank that basically got a call to step in after the FDIC receivership of First Republic Bank assets. And so with that in mind, did the FDIC pulling in other big banks and essentially ushering them into the deal table, did that trigger some of this broader activity and the sell-off in regional banks that we've seen this week?
You know, I don't think that hurt the cause. In fact, there was an initial sort of euphoric action in the price of the stocks, the bank stocks, after that $30 billion infusion into First Republic. But the issue seems to be, at least for the ones that failed, seems to be on the capital side, not necessarily on the liability side. And when you infuse 30 billion of deposits, it essentially increases the liabilities. Now, it helps with the funding, but what First Republic needed was equity capital, not necessarily additional, because what it turned out to be essentially the 30 billion of deposits was really 30 billion of additional borrowings, right? Because they did ultimately eventually have to pay that back. So I think that if the big banks were to, rally behind other banks, it wouldn't be a negative. But now at this point, the way the bank investors are reacting to any intervention from other big banks, it could be viewed negatively, because the reason why they had to infuse $30 billion into First Republic was because it was teetering. So it's a very, you're kind of walking on eggshells if you're a bank management team, where you don't necessarily want to come out and, take some help from other banks, because it may signal that there's problems, under the hood with your own bank. So they have to tread carefully in this type of environment.
So then if you are trying to invest in banks right now, and you're already seeing that JP Morgan has already taken on First Republic, when you think of other big banks then who might have to come to the rescue, as they've already passed that 10% threshold, where does that leave bank investors, and how are they viewing this landscape?
Yeah, so the way we're recommending to investors is focus on the defensive names and focus on the ones that screen better on a tangible book value on a fair value basis. So we like New York Community Bank, we like M&T Bank, we like Fifth Third, Regions Financial. These are all banks that I'm kind of viewing them as down the fairway in terms of their stability of deposit flows, stability of their capital base, and they're types of banks that I think investors won't be spooked about keeping their deposits in there. So there is a way to invest in this type of environment, especially for those banks that are not teetering. You're getting a bit of a discount in this type of environment. Now, with that said, we're being very selective with the names that we're recommending, because we think from an industry perspective, this pressure on net interest margins and funding costs is going to continue to pressure the group for the next 3 to 4 quarters, and then credit quality is going to start to rear its head on the commercial real estate front over the next 12 to 18 months. So we are very cautious on the group overall, but there is a selective way to participate if you're a bank investor.
All right, a lot of these regional banks scrambling to make par right now. David Chiaverini, Wedbush Securities Managing Director, Equity Research. David, great to have you here with us this morning. Appreciate it.
Thank you.
Definitely. Potential sale of PacWest Bank. It introduces a new stress point in the banking sector. This presents another risk for the Fed to consider after delivering an additional rate hike yesterday for the 10th straight meeting. For the first time since 2007, rates now sit above 5%. Meanwhile, the question of what comes next, that still lingers. Fed Chair Powell's remarks yesterday leaned on 2 words, offering some clues as to what investors should take away from the Fed's thinking. Meaningful and restrictive, those 2 words. Take a listen.
We're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. With our monetary policy, we're trying to reach and then stay at for an extended period a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time.
But with added banking stresses and several economic unknowns, where does this leave the markets? Here to discuss, we've got Hugh Roberts, who is the Quant Insight Head of Analytics. Hugh, great to have you here with us this morning. So perhaps we start there with that very question here, and largely what this means for the banks as well that have essentially been extremely reactive to the Fed's policy as well as some of their own decision-making on the management levels.
Yeah, so we would give a very different perspective to your previous guest. It was fascinating listening to David, who's obviously clearly in at the very single stock level. What we have is a smart machine, an AI-driven machine that just basically looks at everything through a macro lens. So when we look at everything versus growth, versus inflation, credit conditions, risk appetite, all that kind of stuff. And if we look at KRE, for example, at the moment, to get an aggregate picture of regional banks, then macro momentum is still pointing south. There's no immediate respite for the regional banks coming from the macro picture, at least. So on that front there's no real kind of immediate opportunity. I think more broadly from our side is we're kind of a little bit like Chairman Powell yesterday. I mean, watching the press conference, I got the impression he kind of gave a hospital pass. The issue now of the regional banks is really one for the regulator, rather than for the Federal Reserve and for monetary policy or financial stability. And now we're kind of looking at that big picture stuff as well, rather than the kind of minutiae of individual names.
And Powell did note the senior loan officer survey SLOOS. That's going to show that the tightening is continuing in the banking for some of these smaller banks, and that's tightening considerably. How much does this then bring forward the timeline of when we could see a pivot if these tighter lending conditions essentially act as another hike?
Yeah, I think that's exactly right. I mean, the minutes of the March meeting that came out a week or so back confirmed that the Fed now acknowledged that the kind of the credit crunch that we're seeing at the moment work in the same direction as rate hikes. So we're kind of getting a double whammy, if you like. So I think that's a very fair question in terms of does this kind of expedite things. Again, to reiterate, we don't really have forecasts per se. We don't forecast, is a recession going to hit in Q2 versus Q3 or even Q4. What we do really is measure the relationship between any individual asset and the broad macro environment. That's what our AI machine does. So my answer to that question would be more along the lines of, we can look, say, across sectors and say, right, which of the US equity sectors are most vulnerable should US high yield credit spreads start to widen? And the answer to that question would be actually it's the property sector. It's stuff like XHB, the home builders, it's stuff like home construction. They are the sectors that screen as the ones that would be most vulnerable if credit spreads start to widen because of the credit crunch starts to really hit up. And if we get evidence of that, as you say, from the Fed Senior Loan Officer survey next week.
Based on the Fed's policy pathway as of right now, many of the bank CEOs had come out early in earnings season and said that they're looking for a recession to come in Q3 of 2023. From what you're seeing from an economic perspective, from what you've heard from Fed Chair Powell's commentary yesterday, and even the glimpse of what they may do from here, what does that spell out to you? Are we looking at Q3 2023, or from a quant perspective, is there something else at play?
Yeah, I mean, I personally, my kind of non-QI answer would be that, yeah, all the ingredients for a recession are clearly there. In fact, just in the last week, look at the message coming from the bond market, look at how commodities are trading. It still feels very much like the recession will come. It's just that the leads and lags have been thrown out. I mean, everything goes back to COVID and lockdowns, and it's just been an incredibly difficult cycle to time. This time around. So I think it's still a question of when rather than if would be my personal answer. So really what we then do is use the machine to try and find the assets that are trading rich to macro conditions, and therefore kind of lag to potential recession and therefore offer a good entry point. And those two kind of home builders, home construction ETFs would be examples of that. Or we look for assets that have actually kind of overrun things and have sold off too much in advance. So again, sorry to duck the question. It's not that, it's just that we don't really predict or forecast. We don't have a call on the US economy or whether the ECB continue hiking for another 50 basis points or not. What we capture is the relationship between all these assets, single stocks, currency crosses, et cetera, and the broad macro environment.
So as you look at some of the sectors then that have already sort of priced in, I guess, the best case scenario, which ones are the standouts for you?
There aren't many, I'm afraid, at the moment. If you're looking to buy the dip, then the best we can get really is stuff that's actually trading close to model value and where model value isn't falling, model value capturing the entire macro complex. Something like metals and mining, XME, clearly is a cyclical player in most people's eyes. So obviously the commodity story will have an influence. But if you look on our machine, then it's bang in line with model value, and model value is moving sideways rather than declining. So that would be a kind of cautious long from our side. But at the moment, the skew is very much towards assets that really are trading rich. That would include technology. The trouble with technology is they're not macro plays at the moment. One of the things that the machine spits out is a model confidence number. So that enables you to say, well, this particular security is trading off a macro dynamic, or it's trading off company fundamentals, is more idiosyncratic. And although we have XLK, we have XLC, all this stuff as a little bit rich at the moment, they all have low model confidence. They're driving off generative AI as a story rather than anything else, anything macro.
I do appreciate you breaking all that down for us. A big thank you to Hugh Roberts, Quant Insight Head of Analytics. Thank you for your time this morning. All right, shares of Qualcomm are falling this morning after the company provided a weak forecast, warning that softening demand and a challenging macro environment would have an effect on revenue. On the earnings call, Qualcomm executives mentioned mobile phone demand will continue to get worse. The company also saying it sees no evidence of a recovery in China. We'll dive deeper into those numbers on the other side of this short break. Qualcomm managed to meet earnings expectations in the quarter, but its gloomy forecast stole investors' focus away. The company's revenue forecast for the third quarter fell short, signaling that the demand for smartphones remains slow. Qualcomm CEO Cristiano Amon blamed the results on a tough environment, and the company says has not seen a strong sales recovery in China. Joining us now to break it all down is Yahoo Finance's Dan Howley. Hey, Dan.
That's right, Rochelle. This is a kind of a continuation of the kind of commentary and results that we've seen from other chip makers, not necessarily in the mobile space, but from Intel, AMD, both of them reporting earnings that were basically just slammed because of a decline in consumer interest in purchasing goods. That has to do with the PC market. Qualcomm is on the smartphone side of things. They also said they were hit by a customer that makes purchases in China on modems. Hint, hint, that's likely Apple. But, when you look at these numbers, revenue down 17% year over year. If you look at the segment results, handsets revenue is down 17%. Internet of Things was down 24%. The only bright spot here really is automotive, and that is a small portion of the amount of revenue they bring in, $447 million, compared to the $6.1 billion that they bring in through handsets and the $1.3 billion they bring in through IoT. So I have a feeling this is something we're going to continue to talk about. What does this mean for handset makers in general? Well, Samsung obviously was running into trouble because of a decline in memory prices. That's not necessarily related to its own handsets, but you can imagine that would be a problem with its own handsets as well. As far as Apple goes, I mean, they report later today, and some analysts are saying that there's going to be potentially a beat on expectations, but for the upcoming quarter, the third quarter, they're expecting a miss on guidance, perhaps.
Dan, it's interesting. And as they were talking on the call, of course, there were the AI and models mentions there, as well as we've heard through all of the chip companies at this point in time in their earnings, but also saying that this is the best product roadmap in history and strategic customer relationships across multiple industries that they've had in quite some time. Is the street buying that narrative right now?
No, not right now, if you look at the share prices. But I think that, this is kind of a issue that when you look at the chip companies themselves, they're basically trying to run down their inventory and just make sure that they're cleared out. And once they do start getting the demand back, they'll be able to, just ramp back up and provide it. But I think, when it comes to the broader discussion with AI, that is a little bit further out for some firms. Intel was discussing AI, AMD discussing AI. NVIDIA is really the big 800-pound gorilla in the room when it comes to that segment. Qualcomm is getting into there. Obviously, there's AI on your smartphone, so they do have AI components that they build into their chips. But I think the larger conversation around that is still really in NVIDIA's court.
Just lastly, while we do have you on this, and of course, noted history between Qualcomm and Apple. Now Apple is really taking more of that production under its own helm and trying to kind of vertically integrate that. But is there anything, I guess, still from Qualcomm's results in the handset division that can tee up what we might expect from Apple? Yeah,
the modem discussion that they had, that decision to not purchase or hold off on purchasing modems, that's what Apple uses, right? There was all this discussion about how Qualcomm was going to lose billions because Apple is ditching them. They want to build their own modems. That's, what Apple's been doing. As you said, vertically integrate across the board. They haven't been able to do that yet with their modems. And so that kind of issue is what also impacted Qualcomm. So, they're aware, investors are aware that Apple's going to leave. I just don't think that they were expecting a slowdown in purchases at this point. Eventually they will leave. They're still a customer though. Right. And they just weren't expecting that in this quarter. Really interesting. All right, teeing up, of course, what's later to come today in Apple's earnings results. Yahoo Finance's own Dan Howley. Dan, thanks so much. Thank you. Also, everyone, shares of Paramount, we're tracking those this morning. They're plummeting after missing estimates on both the top and bottom line in the latest quarter. The company also slashed its quarterly dividend to 5 cents per share from 24 cents. Let's bring in Ali Canal with the details on this one. Ali, what do we know?
Yeah, another disappointing disappointing quarter for Paramount. If we take a look at the numbers here, revenue coming in at $7.27 billion. That was off the expected $7.43 billion. Adjusted earnings of just 9 cents versus the 14 cents expected. Now, one bright spot here for the quarter was the surge in net additions for Paramount Plus subscribers. Those came in at 4.1 million versus the 3 million expected. We also saw global Pluto monthly active users hit 80 million. But again, this company is just dealing with cash burn, free cash flow still in the negatives. They did say that in 2024, they are going to expect free cash flow to be positive, a return to earnings growth off of a slew of various initiatives. The call is continuing on right now. It's just about to wrap up. But on the call, they kept driving in this point of returning value to shareholders over the long term. That's one of the reasons why they decided to cut that dividend payment by so much. It was 24 cents. Now it's 5 cents. They're hoping that can improve their balance sheet. They did say on the call they want to continue to divest non-core assets. They're going to re-explore that sale of Simon & Schuster. And they really do want to make sure that they are returning to that earnings growth, returning to that positive cash flow. But in the short term, there's going to be a lot of pain. Advertising, also a dismal part of this quarter. Ads within the TV media unit, that fell 11% year over year in Q1 after falling 7% in the fourth quarter. Now, management has guided that the back half of this year should see some improvement, although analysts on Wall Street, they are a bit skeptical of that timeline. So a lot of problems at this company right now, but they are trying to really perk up investor confidence heading into the back half of the year and into 2024. But with shares off nearly 20%, it seems like they're not doing such a great job right now.
Absolutely.
And Ali, to that point, how much of this then is an industry-wide problem? We know we've talked about some of this ad spend getting more consolidated versus a Paramount-specific problem.
It certainly is an industry problem. It's a macro problem. We're seeing advertising hammer these companies across the board. We'll hear from Warner Brothers Discovery tomorrow. That's another legacy media giant that has dealt with a lot of advertising headwinds. So it's certainly cyclical. Even when we talk about these accelerated streaming losses, you know, all of these companies, that is what they've been dealing with, this intense cash burn. On top of that, you have risks of the writer strike going on right now. Bob Bakish, he just talked about that on the earnings call, saying that right now they have a lot of content in the can, but in terms of the impact it could have on revenue and their balance sheet, that's all going to depend on how long this strike continues. And right now there's such a stark gap between what the writers want, what the studios want, that it's a possibility that it could continue for quite some time. So it's not totally a Paramount specific problem. The problem, though, is that Paramount has a lot of these other assets. They are in that legacy TV business at a time, and we're seeing a lot of cord cutting. So they're really trying to re-strategize. They're trying to focus in on streaming. There's been rumors and reports of sales of different parts of their business, like their BET Media Group, but all of that remains to be seen.
All right, we're going to be watching them coming into the start of today's trading activity. Yahoo Finance's own Ali Canal breaking down all things Paramount. That call about to wrap up. We're taking a look at the U.S. futures here, down across the board ahead of the opening bell. As trading commences on Wall Street, here's a live look at the New York Stock Exchange. And you are taking a live look at Kenvue. Of course, that's the spinoff from Johnson & Johnson, ringing the opening bell at the NYSE. Time now for a check of the market, sponsored by FlexShares this morning, as we are officially open for trading here on this Friday's Eve. May the 4th be with the markets here. As we're taking a look at the Dow, the S&P 500, and the Nasdaq, they're going to need all the 4th they can get. The Dow right now is down by about 0.2%. S&P 500, you're seeing that down fractionally as well, 0.2% in declines there early out of the gate. And the Nasdaq Composite, the tech-heavy average, that's down by about 0.25%. Rounds out to about 30 points there in declines that we're tracking right now. Rochelle.
Of course, also not strong with Peloton. Those shares falling sharply this morning. That's after reporting a larger than expected loss. And the company did point to signs of progress in its turnaround plan, but the optimism did not seem to sway investors, given the reaction that we're seeing in the shares this morning. You see they're off more than 13% right now, Brad.
Yeah, I've been looking into this report here a little bit, Rochelle, and a few things kind of jump out to me as you're seeing shares move lower this morning. One, of course, they're talking about the sequential and one-point investors' direction, of investors' attention in that direction. But year over year, you've got some pretty stark declines here. In total members, that's down 5%. If you're looking specifically at the net connected fitness subscription additions, those additions are down 62% year over year as well. And then even the products revenue, you're seeing that in decline by about 45%. But one thing that I kind of zeroed in on here, especially given some of the partnerships that they've been able to bring on. You think about Amazon, you think about Hilton, and even Dick's Sporting Goods, trying to get into these different capacities where there would either be usership of the devices or purchases of the devices. However, those connected fitness devices in those particular areas of an omni-channel sales approach could come at a promotional or a discounted measure here. And they talked about that kind of on the last page of this earnings call, saying that they're looking to get back to, or not the last page of this earnings call, the final parts of the statement in this earnings call, saying that they're looking to lean in to some of those partnerships, looking for more unit sales and revenue growth. But if those revenue, if that sales and revenue comes at the expense of some of the promotional events like Prime Day that they call out as well, that is going to be growth in the revenue and the sales perhaps, but at what margin? And I think investors are right to kind of zero in on what type of margins we should now expect for this company to bring forward as it's continuing its, what it's calling a turnaround story as well, and that strategy.
And as you mentioned, there's sort of growth at what cost? We're seeing a lot of these markdowns, these discounts, trying to get into different markets when they paired up with Amazon as well. And when you think of Amazon, you think of the existing things that are on there in terms of that space, in terms of the bikes and everything else. There's already tough competition to try and put yourself out there, and especially at the price point that Peloton has, even with the subscriptions. But you see, they did bring on a lot more subscribers, more than the street was expecting. But then you also have to wonder also about the quality of the experience. It's a very different world than when we were in the thick of the pandemic. You had that tight community. People are back in gyms. People have more options now than they have. And people are still waiting to see what's next for Peloton. So even with, beating the street for the most part, investors really still not sold on this turnaround story just yet.
I mean, even at the height of in-home fitness during the pandemic, I went out and bought some rubber bands, Rochelle. I didn't need a Peloton to bring into my studio apartment in Bushwick, Brooklyn at the time. That a personal issue more so than a desire to buy a connected fitness device and resources to do so or not. But I guess at the same juncture now where you've got more focus around getting back into the boutique fitness experiences or getting back into a IRL gym experience as well, Peloton still right now has an issue of where some of the people who purchased those bikes at the onset of the pandemic and at the height of when they were doing more in-home fitness, now offloading them on platforms like eBay. They addressed that in the earnings in the earnings release, saying that the secondary market, they're seeing more Peloton hardware devices make their way there, and former Peloton owners now selling them there, and new all-access members that are now purchasing those and kind of opting into a higher experience, perhaps on the subscription. But still, it's an acknowledgement that yeah, some of these people are churning out, if you will, of the in-home fitness experience and seeing some of those devices sell for even less now, which challenges whether or not Peloton is going to be able to sell them at full price. If somebody's just like, yeah, I can get a previous generation over on eBay for half the cost maybe. So that... And
I will say, I was definitely one of those people who bought when I was like, yeah, let me get this Peloton. And then I remembered, I don't even like biking. Like, what am I doing? But I got caught up in the, let me get fit while I'm at home. No. And I ended up selling mine on Facebook Marketplace. So I'm guilty. I'm one of them.
That is a very noble acknowledgement. Being on a Peloton bike and saying, wait a minute, I don't even like biking. Rochelle, I appreciate you for that. Guys, coming up, how are testing companies faring in a post-COVID world? We're going to speak with the CEO of BD next.
During the pandemic, many at home got comfortable doing medical testing in their own homes. But with COVID-19 in the rear view, what's next for multinational medtech company Becton Dickinson? It manufactures and sells a wide range of products from catheter systems to anatomical mesh and also at-home test kits. Here to discuss on the heels of BD's Q2 report is Tom Poland, BD Chairman, CEO and President, who's joined by Yahoo Finance Senior Reporter Anjali Kemlani. Good to have you on the show here. So, Tom, first break down for us this quarter and really what your expectations were going in.
This was another quarter of exceeding expectations, driven by strong demand across our portfolio. We saw hospitals really back in business with elective procedures. We saw strong demand for a lot of our automation solutions, things like pharmacy automation that you can't find pharmacists or you want pharmacists up front helping to do wellness checks, et cetera, for patients. They're adopting our automation and putting that in place. And then we're seeing strong demand for our research solutions where people are really uncovering new secrets of the immune system to develop new drugs for fighting cancer. And some of our technologies are used right in the forefront of that research. So very strong demand there. So really this quarter represented just strong growth across our broad portfolio.
Tom, Anjali here. I know that you did a lot of expansion during the COVID times, specifically for syringes and injectables. I know there's a lot going on in that market right now, broadly speaking. So for the pre-filled syringes for the COVID vaccines, and then on the flip side, we've got a lot of interest in injectables right now with the weight loss market. Talk to me about the impact on BD from both.
Yeah, so we're really proud that during the COVID pandemic, we scaled up our production to produce an extra 2 billion syringes just to deliver COVID vaccines. So 2 billion doses of COVID vaccines delivered around the world with our products. Something we're proud of supporting the pandemic response. And, today we see strong demand, 11 consecutive quarters of double-digit growth in our pre-fillable syringe market, which, as you mentioned, are used for a lot of biotech drugs. Today, the first time ever, biotech drugs there's more biotech drugs in the pipeline than there are small molecule drugs. And almost all biotech drugs are delivered via injection, which we're the market leader in. And so we don't disclose specific customers that we have, but we are by far the world leader. And that strong pipeline of new molecules that are coming out for conditions like weight loss, but also cancer treatment and other chronic diseases, we're seeing strong demand from our customer categories.
Good to hear. Talk to me about the COVID testing. I know that there are point-of-care solutions like Veritor, but we see increasing comfort with at-home testing from the consumer base. Have you thought about increasing in that market? Is that part of the strategy where you're already looking at, wearables and you already understand, meeting the customer?
Absolutely. So first off, it's a great thing that COVID testing is going down. That's a big positive for the world. What we saw is that, as you mentioned, Veritor and our Max Molecular platform, we saw strong placements of those systems for COVID testing. As COVID testing is going down, what's happening is people are beginning to use those platforms to accelerate other types of testing. And so we're seeing strong utilization of those systems for doing things like cancer screening, for cervical cancer, for GI infections, for vaginitis. And so those platforms that were invested in during COVID are benefiting patients in other ways today as customers are utilizing that more advanced technology to benefit patients. When it comes to moving care into the home, that's one of the most significant areas of investment that we're making today. And not just testing, but also solutions that are treating chronic conditions like urinary incontinence. Actually, just this past quarter, we submitted a new product to the FDA that is aimed at allowing blood to be collected, not through a venipuncture, but by a capillary finger stick that could enable blood to be collected, for example, in your retail clinic, and eventually for you to collect your own blood at home is our aim. And so we see a lot of enabling technologies that are going to continue to move care that may have traditionally been done in a professional setting to be enabled to happen in the home, whether or not that's testing or blood collection or even broader chronic disease management.
And as we're moving past this emergency phase of COVID, do you expect COVID testing to become seasonal? What does the new normal look like in that space?
We do. Actually, our main product is a combination product that tests for flu and COVID all in one test. Because on a go-forward basis, we think the question is that someone's going to ask is, I have respiratory symptoms. I have a cold-like symptoms. Do I have the flu or do I have COVID? And so that combination test is going to be what matters. And so we've launched that in the professional setting. We've been doing work to see, can we bring that test into the home care setting, which doesn't exist really today in a rapid test format. And so absolutely. And you're seeing more and more types of tests come to market. People have strep throat tests that they're aiming to bring into the home as well. There'll be many, many more types of diagnostics that you'll be able to do in the home in the years ahead.
How does that market compare to the comeback we've seen in surgery and in other clinical settings? Because I know that's a large portion of your pipeline. So talk to me about that versus this focus on more, point of care, at home, the like.
Yeah, that's another major area that we're focused on are those technologies for the hospital as well. And as you said, what we're seeing is there was major labor shortages during the pandemic in hospitals. Hospitals have found ways to advance that. And so you're seeing backlogs of procedures starting to work their way through the system. And so you're seeing not just BD, but many medical technology companies with increased procedure volumes coming through over the last quarter as those procedures are moving things. You're seeing it in orthopedics, you're seeing it in hernia procedures, you're seeing it in peripheral vascular procedures. People are able to get procedures that have been backlogged during the pandemic. They're getting them done today, and we would expect that's going to continue here, certainly for the near term.
We'll certainly be tracking that. We do appreciate you joining us this morning. Tom Poland, BD CEO, and Yahoo Finance's Anjali Kemlani. Thanks so much. Good to see you. All right, coming up, making moves. We'll share Brian Sozzi's interview with TD Cowen President Jeff Solomon on the company's transition since its acquisition. That's coming up next.
In August last year, Toronto-based TD Bank snapped up boutique investment house Cowen for $1.3 billion. TD's ambitions to boost its operations in the U.S. made Cowen's rapid growth and leading prime brokerage and research units an attractive proposition. The deal creating TD Cowen received regulatory approval earlier this year and comes with obvious upside for both. TD gets a firm foothold in the U.S. equities market, while Cowen's clients see the benefits of a big balance sheet and strong capital markets business. Long known as a top 10 research house, especially on U.S. equities, the acquisition gives Cowen the scale to reach a bigger audience. No stranger to stock research himself, Yahoo Finance's Brian Sazi spoke with TD Cowen President Jeff Solomon at the Milken Conference, but he started with an issue still top of mind, banking turmoil. Take a listen.
I think this is pretty expected, and markets can adjust to things that they kind of expect to come. Like the first time when you saw SVB and Signature, there was a disruption. First Republic has been talked about for the last month, and I think people were hopeful that they could figure out a way to stay independent, but obviously they weren't. The market fully priced in this idea. And I do think that what Jamie said this morning is true. I think this phase of any crisis is over. I don't think there's a whole bunch of others. We've been through a lot of bank earnings, so let's put this behind us and continue moving forward. And that's what the market is saying too.
Do you see other phases of this? I've heard that from other folks that I've been talking to. Some have said, Brian, this is the first inning, which makes me concerned. Well, what does the second inning look like?
Well, I think anytime you've seen a massive change in the way the rate structure works, right? So since the global financial crisis, we've basically been in a zero interest rate environment, right? And so the entirety of the equity market underpinning is focused on this idea that money has essentially been free. And it's not going to be free for the next decade or so. It's just not going to happen. And so if you look at what's happening in inflation, if we've had a parallel yield curve shift, or we have right now an inverted yield curve, it's sort of saying that we're looking at some sort of a recession. How hard, how long to be determined. I think people are looking at commercial real estate as the next shoe to drop. I'm not sure I'm smart enough to know if that's the case, but it's on my radar screen. And so I think when people say like this phase is over, I'd say this phase of adjustment to the new rate structure, and then we'll see if there's fallout from other areas.
Are clients preparing for a recession? When you talk to them, the moves they're making in their portfolios, what does that look like?
Yeah, I think you are. Again, the inverted yield curve is pretty predictive. As I've been asking people, do you think that longer term we're going to be in a situation where short-term rates have to come down, or long-term rates are going to shift higher? And everybody, pretty much the consensus is, that long-term rates are going to be moving, short-term rates will move down. And so, again, the Fed is going to keep its foot on the gas in terms of rate hikes until it's sure that inflation is gone. And then once they are convinced that that's, they've got that underhand, then they'll look at ways to be more accommodative.
I know your firm has the pulse on all things deals amongst stock research, we'll get to in a second. Are you seeing any line of sight to improve deal flows this year? So
we've been saying all year that the M&A market is really going to be a second half of the year market, and this is even before we understood kind of what was happening in the banking sector. If anything, that kind of put a pause on things. And it's not uncommon here. Interest rates are higher, so the cost of doing acquisitions are higher. Multiples will come in on private companies. Sellers have to readjust to what the new reality looks like and what people are paying for cash flows. I always go back to discounted cash flow analysis.
Me too.
Right.
As a former stock analyst, yes.
Yeah, and so
FCF.
Right. So if your cost of borrowing is higher, your multiples are going to be lower. Okay, that needs to be reset, and I think that just takes some time. But we've said for a while that it would be a second half year, and we're sticking by that.
What sectors do you see consolidation happening in?
Well, I certainly think we see the tech sector, right? The tech sector is, a lot of people who thought they were going to have endless amounts of financing are now looking at, okay, what can I do strategically? And so we expect to see some consolidation there. I still think there's consolidation to go in the biotech sector. Those are two big areas for us, at Cowen, Legacy, TD Cowen. And so I think you can pretty much rest assured those things will happen.
And amidst everything we're seeing in the banking sector, you are now part of TD.
Yes.
Where are you at in this integration? When did the deal close? And what are you looking to achieve?
Yeah, so we're still relatively new. It's I think today is our second month, and it's been great. I will just say, When you do these kinds of acquisitions, you think you know, and then once the transaction closes, you see if it's actually what you thought is the case, and it is. Culturally, great alignment. A lot of work to be done understanding how to operate our business model inside a globally systemic important bank, but relatively straightforward stuff for us to be doing. And then when you talk about the opportunity set, really I think where I'm spending a lot of my time is really looking at, on the combined platform, where can we go? What are the things we can do? We have a full suite of products and opportunities in front of us. Let's pick and choose the ones where there's low-hanging fruit, where we can go out and take meaningful share. That's fun stuff for me and for a lot of us, and so that's kind of where we are, and I think you'll hear more from us as we head into what our fiscal 24 is, which is end of October, beginning of November.
Where do you think you could take market share?
I mean, it's still early for me to be making those predictions, and it's good of you to ask, and I'm probably not going to disclose my strategy or our strategy here.
Have to ask.
But I think when you see us, over the next 6 months to 12 months, leaning into certain markets, you're going to be like, oh, that's a really logical place. So I'll leave that TBD, and I'll let you know after we've made some inroads.
All right, so I can't punch anything into my old free cash flow model. Okay, stock research. I've long known Cowen for stock research. What is, this consolidation we're seeing on Wall Street? What does that mean to the business of doing stock research?
Well, so for us, this is part of the primary reasons why TD bought Cowen is our amazing research. And TD did not have a U.S. research, equity research presence. So we're able to integrate their Canadian presence with our U.S. presence. And really, I would say, do the things that we do to drive alpha in the equity portfolios. Certainly, you can see us, the macro research piece, the policy piece. When you look at what TD Securities historically has been in the dealer market, it's been fixed income commodities and currencies. And so we've never really been able to have a view on those that are what I would call the house view. And so being able to integrate those into our research, I think ESG, big strategy at TD, also a big strategy for Cowen. All things ESG as we figure out what's real, what's not real, who's actually doing things that will move the needle in terms of decarbonization, who's not, who are the winners and losers. So much for us to cover in that space. And I just think, when you look at the combined platform, the ability to broadcast what we do over a much broader client base, that's going to be the great story there.
Are you still seeing the appetite for ESG research, ESG knowledge, let's say 3 years into all this interest really exploding into the scene?
I do. It's not going away. Like most markets, right? People can get ahead of themselves and overpromise and underdeliver. People will make bold statements, just like we saw with the internet, right? And all that ended up coming true when it happened. It was probably longer dated than what people thought about. I think ESG is true also. There's going to be a big global push to be carbon neutral by 2050. That the day in and day out reporting on that, the role of regulators in that, and how it all gets reported, TBD. But it's hard to argue that the world isn't heading towards a more carbon neutral, state of being, and so we want to be at the forefront of that to help clients figure out what's real, what's not real, who's actually doing things versus who's just saying they're doing things. That's a vital part of our research footprint, and we also think that how people engage around ESG is predictive in terms of ultimately how their business models play out.
And that was TD Cowen President Jeff Solomon alongside our executive editor, Brian Sazi. And stay tuned. For more from Milken, Brian sat down with the CEO of Levi Strauss to get his take on the state of retail. That's coming up in the next hour. And coming up on the other side of this short break, why our next guest says there are many reasons for the bulls to be shouting. We'll speak with Crossmark's Victoria Fernandez. That's coming up next. Good morning, everyone, and welcome back to Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. We're taking a look at markets right now, 30 minutes into trade today. The Dow Jones Industrial Average right now, that slipped just a little bit lower from where we opened up today's activity. As of right now, you're seeing it down by about 0.75%. The Nasdaq Composite, you're seeing that lower over the past 4 days by about 2%, adding on to some of those declines this morning by about 0.5% here. I'll put this on an intraday view just so you can see exactly where some of the activity has transpired this morning, and the S&P 500, you're seeing that in the red as well right now by a little more than 0.5%, about 0.6% in the red, 24 points to the downside there for the S&P 500. Let's take a look at some of the sector activity for the 11 S&P 500 sectors. Energy is actually higher here today by about 0.2%, but really only two bright spots here with energy and real estate kind of leading the way and flip-flopping their leads. But as of right now, you're seeing financials on a big day where banks continue to be in focus. Financials lower by about 1.2%. This activity coming after the Fed's decision yesterday. And then additionally here, the commentary from Fed Chair Jerome Powell acknowledging what's taking place in the banking sector. We'll continue to see what continues to move forward there. Want to also just zero in on, well, I was going to do it on technology a moment ago before things moved around. XLK, taking a look at tech. Right now, you're seeing that down by about 0.6%. And why focus in on technology? Oh yeah, you've got a $1 trillion company in Apple that's going to be reporting earnings later today after the close. Apple right now going into that earnings event down by about 1.3%. We'll see where that continues to move as we go on throughout the rest of today's session, Rochelle.
All right, thanks, Brad. Well, if the attendees at the Milken Institute Global Conference are any indication, most folks have recession on their mind. Take a listen.
We are probably heading into a recession at the back end of this year.
We're looking at some sort of a recession. How hard, how long to be determined.
It's interesting, they went around the room today and they asked, when do you think the recession's coming? When do you think the recession's coming?
If demand goes up, we could see prices going up. Now, at the moment, there are concerns about economic slowdown, recessions.
It is a recessionary backdrop, but, as I have sometimes said, I think we're going to have a non-recession recession.
Joining us now to dive deeper into what's ahead is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Good to have you on this show, Victoria. So as we saw there, a lot of talk about recession and trying to get a clear picture of the type of recession. And on top of that, you have then the strong consumer. Help us make sense of your predictions here and what you see in terms of a recession ahead.
Yeah, so we do see a recession coming later this year. The clips that you were just playing, it seems like everyone anticipates it. It's the timing that's more of a question and the size of that recession. So we expect to see it later in the year, maybe beginning of fourth quarter, end of the year, and it should be a mild recession. And we think mild because of the strength of the consumer, as you just mentioned. The consumer continues to hold in there. And if you look at some of the information coming out of the last GDP report, it actually showed consumer savings moving up from 4% to 4.8%. So they're building their own little nest egg once again after spending down all the stimulus payments that had come in. People thought that would be the end of the consumer. Demand would decline. It looks like they're setting themselves up to continue that spending as we go. I don't think it's going to be enough to counteract all of the headwinds that we have in the market. So there will be a recession, but I think it'll be somewhat mild.
What areas of the market would be most beneficial from a resilient consumer right now as you're tracking in terms of an investment or a portfolio play that some investors out there may be looking to enact?
So we always talk about when we're heading into a recession, you want to focus on those names that have what we call the quality factor. So it's not necessarily a particular sector, but within the sectors, who has the strongest balance sheets, who has that good cash flow, who has the good management teams. Those are the names you want to focus on, but have some exposure to some defensive names like healthcare or staples. Cigna is a name we've been adding to, but that doesn't mean you don't have that consumer exposure because we think they're still there. So we like credit cards like MasterCard and Visa. You could go a little more cyclical with American Express if you wanted to, but also some of those names like a Coca-Cola or a Pepsi allow you to have some exposure to the upside of the market as the consumer stays strong.
And Victoria, we know in a lot of these earnings calls, we're still hearing about those macroeconomic pressures and some cautious tone that we're hearing in some of the forward guidance as well. When you think of this phase that we're in now with the Fed, sort of bracing for a pause here, how should people be positioning themselves?
So it's interesting, I guess you have to determine first if you are not going to fight the Fed or if you're not going to fight the market, because they're really telling you two different things. You have a market saying you're going to have about 3 cuts before the end of the year. You have the Fed saying there will be no cuts before the end of the year. So you have to kind of decide which part of that argument you want to be on. We tend to agree that the Fed is not going to have cuts the rest of the year, that they might pause at the June meeting. That opportunity is there for them to do. But I just don't think, Rochelle, that we can bank on that. If inflation numbers continue to be high, especially that super core number that they look at, if we continue to see that move higher, the core CPI moved higher last month. It didn't come down. If those things continue, I think the Fed has the opportunity to go another 25 basis points in June and then start their pause. So there could be some more tremendous volatility for the rest of the year.
It seemed like coming into this earnings season, there was talk of an earnings recession. From what we've seen from companies thus far, is there anything that points to, and even given the beats that we had seen on some kind of beaten down expectations, should that be the expectation at this point, that companies are going to continue to signal caution and kind of sandbag some of the expectations in the street until they get the all clear from the economic framework?
Yeah, so it does look like we're going to have the second quarter of negative earnings coming through. We had it last quarter. It looks like we're going to do it this quarter, but at a much lower level or margin, I should say, than what was anticipated. Originally, it was looking to be 6 or 7% down on earnings. Now that's around 3.5%. So it's come back. And like you said, that bar was lowered pretty significantly to make it easier to beat. So look at the guidance, see what's going on. We're hearing a lot of information around buybacks, which would be supportive on a short term for the markets. Strength of the consumer, but again, supply chains, all of those things are still part of the conversation, even though they're improving. So I think we get negative earnings this quarter. Pushes out, the conversation again as to next quarter, what do those estimates look like? They're not coming down as much as people anticipated them coming down. So does that mean the market's actually looking for something better? If so, that looks kind of in conflict to me to what the Fed's telling you. So again, we must be cautious.
And Victoria, in terms of the next catalyst for the markets, I mean, some analysts we spoke to said it all depends on what we hear from Apple at this point. Obviously, a massive company, incredible influence, and especially global exposure to countries like China. What do you think is going to be the next catalyst for markets?
Yeah, no pressure on Apple at all, right, with the earnings report this afternoon. I think when we're looking kind of on a macro perspective, obviously what's happening in the financials and in the banks is going to be key. We were speaking a little bit earlier in the green room about maybe a self-fulfilling prophecy coming here on some of these. The more people talk about the concern in the banks, the more you have people pulling out deposits, and then the more you have talk about deposits going down. So that's obviously an issue. Commercial real estate is going to be an issue if it flows through to that. Commercial real estate makes up 65% of the loan book for small banks. So I think if we combine that with some of the issues that we're seeing already, and again, we have earnings continuing to come down as we go through the year, earnings expectations, all of that together with 500 basis points of hikes working their way through the economy, I think you're sitting at a level that could be pretty concerning.
Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Thank you so much for joining us here in studio today.
My pleasure, yes, thank you.
I speak with you all the time through the television. Yeah, great to have you here.
Thanks.
All right, guys, shifting gears here. Shares of the bank, PacWest Bancorp, sliding this morning by 42% on fears that the banking crisis isn't quite behind us. To better understand this regional lender, we're joined by Diane King Hall. Diane, what do we know?
All right, so let's set the stage here. Pacific Western Bank, or PacWest, is a regional lender. Hence some of the issues that we're seeing. Headquartered in LA, it was founded in 1999, so it's not that old. The company caters to small and VC-backed businesses. The California-based bank is similar in some ways to fellow California banks SVB and First Republic, but PacWest financials make it clear it is very different from the two recently failed institutions. For starters, the company hasn't fallen victim to the massive capital flight that tanked SVB. PacWest has actually seen core deposits increase since banking turmoil began in March. Now, deposits at the institution total $28 billion as of May 2nd. also important to note, 75% of PacWest deposits are currently insured, and their cash and available liquidity exceeds uninsured deposits. Now, for comparison, at the end of last year, SVB, Signature, and First Republic all had a majority of their deposits uninsured. So there are definitely some differences, but we are seeing the issues that are occurring within the regional banking sector just to start to infect the larger banking industry, or regional banking industry, I should say.
Yeah, we've been tracking the... Rochelle, go ahead.
Well, I was going to say, because we keep hearing about this not being a systemic issue, but then psychologically, when people see their bank in the news, when they see these stocks going down, it makes them panic. So how do you sort of differentiate sort of the psychological panic versus the actual sort of issues within the banks themselves?
It is hard to differentiate that. I mean, the point is that PacWest is trying to reassure investors that they don't have these same kind of problems. But yeah, you do start having this, to your point, a psychological thing that occurs, and it almost becomes, as the guest mentioned, a self-fulfilling prophecy of, one shoe drops and then it starts to create concerns about, are there other cracks in the armor? I mean, look, PacWest has already been halted for volatility today. Shares falling double digits. You're seeing that ripple effect within the regional banking sector with regard to the KRE index. You're seeing that drop as well. Looking at PacWest down 43%. So you're just seeing these concerns just ripple out to within the stocks, and that is affecting just the regional banking industry. Now, we did have Fed Chair Jerome Powell try to kind of assuage concerns about issues there, saying that yesterday that, that he did feel like there was stability now within the regional banking sector. I mean, look, he's not going to come out and cry wolf, obviously, but he did try to reassure investors. Also had JP Morgan Chase CEO Jamie Dimon speaking earlier in this week after taking over First Republic as well, or the majority of the assets of First Republic, saying that he believes the issues within the regional banking sector have been contained. And he did say that he does expect further consolidation, but that would be more of a deal activity kind of occurrence.
Absolutely. We're going to continue to track this throughout the rest of the day. Thanks so much, Diane, for breaking this down. Everyone, let's also talk about Shopify this morning. This is one of our trending tickers today. Shares of Shopify popping after posting a surprise profit in its latest quarter as it takes steps to change the shape of its business. The company announced it's going to sell a majority of its logistics business to Flexport and is going to receive stock representing a 13% equity interest in Flexport on top of what already exists. All while Shopify also looks to lay off about 20% of its workforce. Shares this morning are up by about 26%. Coming up, the downhill trend for Peloton continues after its wider than expected loss. We're going to break down some more movers coming up next. Welcome back to Yahoo Finance Live. Let's do a quick check of the market sponsored by Flex Shares. Dow, right now, down 0.7%, 236 points in the red. The S&P 500, also seeing that in the red, that's down by about 0.5% right now, 21 points in negative territory. And the Nasdaq Composite, that too, not looking too great. It is down by about 0.4%. We'll round that off to just about 44 points there. Let's also take a look at the individual performance of today's big movers. Let's start things off with Etsy here on the day. The company beat Wall Street estimates after the trade, or after the bell, Wednesday rather, when it reported earnings. Strong demand for personalized gifts and higher transaction fees helped the company's bottom line. Etsy shares were up by about 0.5% before the market opened. Shares right now, though, they are down more than 5% here. Taking a look at the actuals versus the estimates, there's that beat on both the top and bottom line that we mentioned here. And the company saying that they, again, delivered solid top and bottom line performance in the first quarter. They maintained the vast majority of their pandemic gains, and they're saying that they were able to do that in the face of stiff macroeconomic headwinds, Rochelle.
It's true. And they did note that the revenue outlook did come in below expectations, which might be why we're seeing a little bit of selling action this morning. But, you know, in terms of actually gross merchandise sales, how much people are actually spending per purchase, that's in pretty healthy shape. But some of this might be seasonal. I mean, you have, Mother's Day coming up, you have these different things. And obviously, you have a lot of companies like Shopify, you have a lot of other options for where you sell your goods. Etsy is, pretty much about the little guy. It's more of this handcrafted story. So I would like to see Etsy turn this around. But I mean, you have tough macroeconomic conditions. You do sometimes tend to see higher priced goods on Etsy because a lot of it is handmade. And perhaps if you're tightening your purse strings a little bit, you might be looking for a cheaper option there. Yeah, some interesting areas of their financial summary that I'm just zeroing in on here a little bit more. Marketplace revenue, that actually was up by about 9%, and the overall revenue was up by about 10.6%. And the call outs to the gross merchandise sales, that actually year over year declined by about 4.6%. However, didn't impact gross profit a ton, at least. That still moved higher by about 9.6% year over year. So going forward from here for this Brooklyn-based company, and yes, in my biased opinion, I am giving them that shout out, given that I live not too far away. I hope that they do continue to really provide this opportunity, this platform for the sellers that are on there to really just continue to show off their creativity. And it's going to come at the competition for Etsy because you've got so many other platforms that are either looking to inspire and turn that inspiration into a purchase decision that's being made. A lot of question about, does Etsy need a partner in that in some social media company? And so we'll see, where they're able to develop even more of those kind of handshake agreements to drive more traffic through to Etsy's website. I mean, you raise a good point, especially when you think of Amazon teaming up with Pinterest, because that also is, a little more kitschy. But when you have something teaming up with something the size of Amazon, at least makes the sale a little bit easier. Yeah. All right, also going to talk Moderna now. They delivered a strong Q1 earnings beat this morning, a surprise for Wall Street analysts who expected the company to report a loss on both earnings and revenue. The company reiterated its full-year guidance of a minimum of $5 billion in revenue from its COVID-19 vaccine. The company's CEO, Stéphane Bancel, noted in a statement that the COVID-19 vaccine contract discussions are ongoing with Japan, the EU, and other key markets like Australia. You see there with a top line and bottom line, a top line beat there of $1.86 billion on that revenue. Yeah. A lot of people were wondering what's going to be that next story for Moderna post-COVID, how they're going to sort of build on some of that mRNA research and activity there, Brad. No, spot on. And you took the words right out of my mouth. I mean, that is essentially what this comes down to. When you've got the messenger RNA technology that they've been able to pioneer as a platform and show the efficacy and the better efficacy that they can bring to solutions for many different types of viruses or illnesses, I think that's where a lot of these street expectations are starting to bake in. Okay, what does this mean for cancer therapeutics? What does this mean for other, common colds, things of that nature, where the platform in itself can be almost kind of a copy-paste edit for other different
illnesses or viruses. And so even within this, they're talking about some of the future launches. It's investigational RSV vaccine for older adults. They're preparing for a potential 2024 commercial launch of that. And then they're also in phase 3 trials this year for their individualized neoantigen therapy. That's in combination with Keytruda, and that's going to treat melanoma. So all these things considered, I think the runway here for Moderna, investors really tracking this one closely to see where else messenger RNA technology can benefit the company and hopefully society as well.
Indeed, and hopefully we'll hear more about that. Stefan Bancel will join Yahoo Finance live next hour to discuss the company's surprise Q1 profit, as well as demand for COVID-19 vaccines. So you don't want to miss that.
That's right. Also, we got to talk about NYC-based burger chain Shake Shack. They also beat estimates, posting a smaller than expected earnings and revenue loss. The company saw same-store sales grow more than 10% in the first quarter versus 2022. Led by higher menu prices and strong in-store performance. Though, Shake Shack did say that costs for beef and fries, they went up. They increased in Q1 from last year and the prior quarter. It expects double-digit percentage cost increases in the second quarter compared to last year, and for fried costs to increase by 20% in 2023 compared to last year's shares right now. You're looking at Shake Shack, well, they're doing pretty good right now. They're up by about 13%. Also got to talk about Papa John's briefly. We'll bring them into the food convo here. Papa John's International, they delivered a Wall Street estimate beat. They topped out first quarter profit expectations and revenue, and same-store sales fell short of expectations, though. The company reiterated its long-term plans to develop 1,400 to 1,800 new restaurant units through 2025. Shares of the pizza maker here, you're seeing, well, we saw them a moment ago on the screen, but taking a look at Papa John's shares, they are up by about 3.2% right now, Rochelle.
That's right. I mean, there's some things that people are going to stay loyal to, and their food brands are definitely one thing. And we saw when we've been talking about the whole snacking thing, and people are really not willing to cut back on their snacks. A lot of loyalty here. People want something that's fast and convenient. They're not spending as much when they go in, but they are still going in and going in more often to a lot of these stores. So it's going to be around for a while. And obviously, when you think of Shake Shack and the price is already baked in, you're not going there for a cheap burger. They're really trying to deliver a more premium burger experience. And they have a loyal community, and people are still willing to pay that premium price there, Brad.
Oh, you're not kidding. It is a premium price. Whenever I walked in there last time, I got, I think, the truffle burger, and I was like, this is going to cost me. I already know it's going to cost me. I don't even want to look at the price. But for Shake Shack, that's good news. You get the truffle burger, you got the chicken shack, you got all the different sandwiches that are going to drive some fanfare, hopefully, and get people coming back. I'm not going to lie, I had the truffle burger twice, so I definitely went back for it and just ate the cost and ate the burger. It's quite good. So, highly recommend it.
You have that Cadillac taste, Brad.
Yes, I've got I've got Cadillac burger budget here. Appreciate it. Thanks so much. Also, coming up, a bumpy ride for Frontier. Despite strong spring break demand, excuse me, we're going to speak with the airline CEO. That's coming up next. As the word recession dominates the mind of consumers, retailers are fighting against the current to navigate cost cutting. Denim giant Levi Strauss is among them. And despite a hike in prices, the brand wasn't able to escape the rising cost in goods. Our executive editor, Brian Sazzi, had a chance to sit down with Chip Bergh, Levi Strauss & Co. CEO at this year's Milken Conference, where they discussed everything from the economic slowdown to the growth of its top business.
When I joined the company, we were basically a men's denim bottoms business sold in U.S. wholesale. I mean, that was a big part of our business. And, 12 years ago after I joined, we put a strategy in place that fundamentally was to protect our profitable core business, which is that men's bottoms business, but to begin to expand the Levi's brand and Levi's portfolio further. We needed shock absorbers to absorb all of the potential disruption that could be coming. And obviously, one of the big choices was tops. In the apparel industry, the basic rule of thumb is somewhere between 4 or 5 tops for every bottom. When I joined the company, we were the exact opposite. Our tops business when I joined was only 10% of our total revenues. Today, it's more than 20%. It should be more, and we are, still focused on a much bigger number. But I half-jokingly say, we don't even buy tops market share because we don't even scratch the surface. We don't even have a 1% share of tops.
Why is
globally.
that? Is it because I go to the store, I see Levi's jeans? I still don't think about Levi's as doing this other stuff.
Right, and our ambition or aspiration, if you will, is for the Levi's brand to be a true head-to-toe lifestyle brand. And for us to do that, we have to be successful in tops. So where we have had success is obviously expanding the tops that make the most sense, like a white t-shirt or a white Batwing t-shirt, which we had tremendous success with. But this is a Levi's top. This is an indigo top woven shirt, and it's beautiful. And so a lot of it is just creating the product first and foremost. We got to have the right product, and then buying that product and making sure that it gets to our store. And to pivot the business away from being a bottoms business, you have to buy less bottoms and buy more tops. And every merchant in the world is trained to buy based on what sold last season. So you have to really lean into it. You have to create the right products, lean into it, assort your stores. And we're on that path right now. But our tops business has been growing, double digit for the last several years, and it still represents a real meaningful opportunity.
I went to your website before this interview, Chip, saw a pair of jeans, $325. I thought, wow, is that the impact of inflation? But when I clicked through, there's a real story to these jeans. I believe they're called the selvage jeans. Tell us about that story, and are consumers open to spending $325 on jeans?
In fact, the higher end of our business is probably the best performing part of our business right now. But selvage has this incredible history. And this year we are celebrating the 150th anniversary of the Levi's 501, our most iconic item. And the 501 saw exceptional growth last year. It grew 50% last year. It's our biggest, our most iconic item. And this last quarter, our first quarter, we grew 25%, comping a 50% base. And it is really on fire. Selvage it actually stands for self-edge, which is when the fabric is made, it's made on a loom. And if you go way back into the day when we first launched Levi's, to have an edge on the end of the fabric so that the fabric wouldn't fray, they created this self-edge. And it had a white strip, which later they put a red line down the middle of. And true denim aficionados know what selvage is. And a real denim head will wear their selvage jeans cuffed so that you can see the selvage. I'm actually not wearing selvage today. I own a lot of selvage.
Your secret's safe with me.
You can't see it anyway, but I own a lot of selvage because it tends to be much higher quality product. The other thing I'll mention, so through the history of Levi's, back right around World War I, we developed a relationship with Cone Mills. which today is still one of our important denim suppliers. But back in the kind of World War I days in I think it was 1917 or 16, Cone Mills had a loom in North Carolina, and that white oak loom became really famous to true denim heads. Cone Mills closed that factory about 4 years ago, and when they closed it, we bought the last remaining supply of cone white oak denim. And as we celebrate the 150th, we are launching product with true white oak denim. And it is the last white oak denim you are ever going to be able to buy brand new ever again, because that factory is gone.
Selling $325 pair of jeans, I mean, it's a phenomenal story. The product is great, but the economy is slowing. What are you seeing in terms of demand for your jeans right now, given things have slowed down?
Yeah, so we knew coming into this year that we were going to be navigating a very challenging year, in part because last year was very bifurcated. We had a very strong first half as we were coming out of the pandemic. We grew 20+% in the first half, and then in the summer, kind of the bottom fell out as inflation started to impact the consumer, fear of recession started to grab hold, currency headwinds, and the second half we were basically flat. We were flattish. So we have a huge base period in the first half and a soft base period in the second half, and this year, guess what? It's going to be the opposite. The first half is going to be really, really challenging, and we should see some real progress with some tailwinds in the second half. But, you know, as I look at the consumer around the world, there is, first of all, the US market is where we are seeing the greatest challenges. In the first quarter, our US wholesale business was very challenged. We have two value brands that we sell in the key mass retailers in this country. Those businesses are both off double digits. The lower income, low to moderate income consumer, you know, they are now making very tough trade-offs with their monthly budget. And they are literally to the point where they're making decisions about, do I really need another pair of jeans? Or can I trade down from the Levi's value brand to
what's
a private label?
What's even below the Levi's value brand?
Private label brand at Walmart or Target. And those are the trade-offs that we're seeing. The Levi's brand, the Levi's red brand, our core consumer is in the $50,000 to $150,000 income level, and that consumer is still buying jeans. In fact, the US denim market in the first quarter grew 1%, comping 16% growth first quarter a year ago. So the category is still okay. We're growing share. We're growing share with the core 18 to 30-year-old. We're growing share with women. And you know, our business and the brand is still really, really healthy. But wholesale is very, very challenging for us right now, and especially the lower end of wholesale.
That was Levi Strauss & Co. CEO Chip Bergh alongside Yahoo Finance Executive Editor Brian Sozzi. Coming up, a bumpy ride for Frontier despite strong spring break demand. We'll speak with the airline CEO next. Frontier Airlines posted a mixed earnings report in the first quarter, with a weak start to the period offset by strong spring break travel demand. As the airline gears up for a summer boom, it says it's tweaking its scheduling strategy amid shifting consumer demands. Let's chat all things airlines and summer travel with Frontier Airlines CEO Barry Biffle. Barry, you're always kind enough to take the time here to discuss some of the financials, the vision going forward here. Walk us through the vision for the new routes, the new flight schedule, to really try and keep pace with some of the demand that you're seeing at certain parts of the year specifically.
Well, thanks for having us on. And look, yes, we just reported things yesterday, and we reported a beat for Q1, slightly better on earnings, and we reported our guidance of 7 to 10% margins for Q2 and 10 to 13% in the second half. So the business is very strong, but we have seen a change in leisure demand, and the peak days are even more peak than they were before. And the midweek is just not as strong as it used to be. And so what we're doing is we are shifting our capacity to more concentrate on that. We're actually de-risking the business. If you think about it, we actually can fly less and actually make more money. So, we're really excited about it. I think it's probably the best equity story in the travel space. And I think after today's results, I think we're even a better story. And I think if you're worried about the recession, there's really not a better play than Frontier, because we're already seeing the trade down of people seeking value, because we do offer the best value in air travel.
And so what are the trends that you're watching in terms of consumer behavior? Because I know you said we're expecting to see some changes in terms of capacity in the second half to really exploit this post-pandemic dynamic of consumers here.
Yeah, so what's happened is with work from home and flexible work schedules, what we're seeing is the most common days that people are in the office are Tuesdays and Wednesdays. And so they're really concentrating their work. And so then that also concentrates then their play, if you will, to be more Thursday through Monday. And so what we're doing to exploit that is we're shaping our capacity around that to exploit this opportunity. And we believe it's going to work really, really well. And like I said, we put out very strong guidance for the balance of the year on the strength of this, as well as the other things we're doing, like Go Wild and all the ancillary products and services that we've introduced this year.
Barry, as we're taking a look at the stock over the past month, investors don't seem fully convinced of the strategy. What do you believe that they may be missing about where you plan to really still retain the mind share, the dollar of the consumer, especially as they are looking across a range of flight experiences and trying to figure out where that dollar does go as they're being more scrutinous about their services spending?
Well, it's difficult to speculate what every investor is thinking, but I think there was this narrative that the legacy airlines were better now than low-cost carriers, and I think that's a little misunderstood. And I think we're starting to prove that. The numbers are proving that. Q1 on a relative basis is proving that, and I think if you look at our guidance for the balance of the year, it will be proving that. So I think let's let this flush out as people see the earnings. I think that we'll see the numbers improve, and I think shareholders will be rewarded. But like I say, there's no airline that's actually trading at the multiple as low as we are. So we think it's a great opportunity for investors. So we hope they look through this and recognize the value.
And Barry, you mentioned the Go Wild Pass, the $499 all-you-can-fly pass. When you do have things like that that are giving such a discount for flights, how does that end up affecting your bottom line? And what does that do in terms of strategy going forward for the more cost-conscious consumer?
Well, the $499 that we're doing for this summer is actually fantastic opportunity for consumers who are looking to save money, especially as they've been pinched with inflation. It enables you to have unlimited travel through the summer, through September, actually. And it's great for the consumer in that way. From a shareholder perspective and a Frontier financial perspective, this is limited to seats that would have gone empty, and they're only available more on spontaneous purchases, for travel within a few days. And so these are largely filling seats that would have gone empty. So we expect this to increase our load factors considerably. And these people, obviously, they buy bags and seats and other products once they get on board. Then they get excited about our credit card as a result. And so we obviously benefit from that. So it's great for consumers. It's not a better time to have a product like this when people are thinking about recession, but it's also great for our investors because it's one of the reasons why we have the confidence in our revenues going forward.
Barry, let's talk about the fleet as well. Are there any significant shifts that you see in the number of aircraft that you have right now when you are ramping up or kind of being selective about the routes that you're flying when there is more demand, typically during the spring and the summer and even during the holiday season. Is there a kind of churn or a shift in some of the aircraft that you have that you would like to see the airline move forward with?
No, so there's no real change in our fleet other than our normal deliveries. It's just that we're going to do more of our scheduled maintenance, for example, on a Tuesday and Wednesday, and more park the aircraft and try to fly them harder on the other days. And we already are their highest utilization airline. We'll continue to be the highest airline. But we'll just be slightly smaller on Tuesdays and Wednesdays than we were before. And that's just going to, again, benefit the consumer because it's shaping the capacity around the days they want to go. And it benefits our company and our shareholders because we make more money by actually flying less. It actually de-risks the business.
We do appreciate you joining us this morning on Yahoo Finance. Barry Biffle, there, Frontier's CEO. Thank you for your time today. All right, coming up, Ferrari is revving up its deliveries. Our own Pras Subramanian will give us his vibe check on the earnings call next.
No fear of missing out and sometimes just being plain boring. It's what made Warren Buffett one of the most successful investors in history. In fact, anyone can invest like Warren Buffett. His strategy is centered around the principle of value investing. Finding companies that are undervalued, focusing on long-term earnings, not short-term growth. In other words, buy businesses, not stocks.
If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. We care a lot about the price. We do not care about the next 12 months.
Batteries and paint. Not sexy companies, but guess who owns Duracell and Benjamin Moore? Buffett's Berkshire Hathaway. Buffett invests in companies that have a competitive advantage, or a moat, as he puts it. It's what led him to invest in Apple, his biggest holding.
I just think of basically the utility of those products to a ecosystem that is demographically terrific and finds that instrument useful dozens and dozens of times a day. It's almost indispensable, not only to individuals, business, I mean everything.
Buffett also invests in companies that are easy to analyze. He knew the value of the membership subscription model long before Amazon Prime or Netflix. Berkshire has held Costco for decades. Buffett says he buys what he knows, which is why Berkshire is the largest shareholder in Coca-Cola and Kraft Heinz. Does his approach cause him to miss a few big winners? Sure. He passed on Tesla and Google and was very late to Apple and Amazon.
The fact that you're missing out on 90% of the stuff doesn't really make any difference if the 10% you do is right.
He's always had a penchant for banks and insurance companies. Berkshire Hathaway owns Geico and has stakes in Citi, Visa, and American Express. To invest like Buffett, buy what you know. Buy a business, not a stock. Don't be afraid to be boring, and be patient.
Race results. High-end car maker Ferrari rolling forward on strong deliveries, proving that demand across the luxury market remains strong. Analysts betting its pipeline of upcoming cars, available of course only on wait lists, can help Ferrari maintain its lead over general automakers as the industry moves to electrification. Here with more is Yahoo Finance's Pras Subramanian. Hey Pras.
Hey Rochelle, that's right. Ferrari's first quarter earnings highlighting the continued strength of its core luxury clientele. Ferrari's earnings revenue topped estimates, and the automaker reaffirmed its full-year outlook with an EBITDA margin forecast of 26%. That's a company that knows how to make money. And a big moneymaker could be its newest car, the Puro Sangue SUV. Here's CEO Benedetto Vigna talking about customer reaction that was so strong they had to close the order book.
At the beginning, when we launched the cars, we were not expecting such strong, let's say, reaction from the clients. So we had to put a little bit of stop to organize ourselves so that we could reopen properly. So there is no change in our strategy.
With order books back open, if you want that Puro Sangue, Vigna says to get that order in now. That being said, my key takeaways from the call are this. One, robust demand. Ferrari increased shipments as new cars came online. The 296 hybrid supercar, the Ferrari Roma, these are hot cars that customers want. Vigna mentioned the order book for those cars sold out through 2025. That's how strong demand is. Pricing power in the luxury consumer. That Puro Sangue SUV, it costs over $400,000. Those high prices and the desire of customers for personalization leads to those juicy margins that are the envy of the industry. It seems Ferrari's customers will continue to pay up more for these cars like the Puro Sangue as long as they can maintain exclusivity and individuality. Finally, it seems Ferrari's customers will continue to pay more for these cars like the Puro Sangue as long as they can maintain, I believe that's a repeat of that part. Electrification plan. While the world goes crazy for EVs, Ferrari has to keep its customers happy. And they want those high revving engines and dramatic engine roar. Enter the hybrids. We're seeing the product mix shift to hybrids, and the back half of the decade we'll see only hybrids and Ferrari EVs. And the Ferrari EVs coming in 2025. It'll be a true test of whether true Ferrari fans will accept full electric power when that happens. So in terms of a vibe check, I'm gonna go with good here. I'm going with good. Ferrari's making money, they have the deep order book, and the hybrid game plan is going very well. Those cars are well received, and the question is, by the end of the decade, will its fans accept true electric power, and can Ferrari make it exciting and stand out from the rest of the luxury competition?
All right, so this Ferrari report, it follows strong earnings by Porsche, Mercedes, and others. Mercedes was actually so good, they had to report early as well. So what does this tell us about the luxury car market right now?
You know, you talk about Mercedes, they knocked out of the park. Porsche as well. Even Aston Martin saw deliveries increase and revenue increase, which is kind of a surprise. So we're seeing that luxury consumer is still strong right now, given all the issues we're seeing with the global economy. They're willing to pay up. They're willing to pay higher prices as long as there's personalization options. They want to see that individuality in their cars. And at that level, they're paying up for it. And the question is, you know, does it end? When does it end? It seems like it's unending, but I think at a certain point, when do customers say, you know what, I'm not going to get that cross-stitch leather, right? Yeah. I'm going to go for the standard leather. So we'll see.
I mean, it's kind of just like if you had $1 million to go buy a car, you're probably still going to have $1 million to go buy that car, and you're going to go get the car, and you're not going to care about the cross-stitch leather.
Yeah, exactly.
All right.
Plus, you get an excuse to say Puro Sangue every 2 seconds and feel like the most special person in the room. I'm not mad at that, Pras. I should make that a drinking game. Our very own Pras Subramanian, thank you so much. All right, coming up, we've got a lot on tap all day at Yahoo Finance. We'll give you a sneak peek at what to expect next.
Let's do a quick check of the market, sponsored by Flex Shares. The Dow right now down 0.9%. We are essentially at near some of our session lows that we've seen. Dow Jones Industrial Average, you're seeing that lower 300 points. The S&P 500, that's down 0.6% right now. And the Nasdaq, the tech-heavy average, is down 0.4% here. Just taking a brief look at some of the sector activity as well on the day. The 11 S&P 500 sectors, as of right now, we're keeping a close eye on just two bright spots, utilities and real estate. And financials and industrials right now, they are pulling up the caboose. On the other end, financials down by about 1.5%. We've got a lot coming up all day on Yahoo Finance. We stay in touch with the PacWest story. Could it be the next domino to fall as the banking sector turmoil continues? This despite comments from Jay Powell on drawing a line under the issue. Not yet, it seems, Rochelle.
Indeed. Plus, we'll catch up with Moderna's CEO, Stéphane Bancel. Shares in the pharma and biotech business getting slammed this year, but some bright spots in these numbers too. Don't miss that conversation.
And we're not done with milking. We'll hear from an asset management leader on why things might feel just a little too cheery. Here's a sneak peek.
People look a little too happy for me here. We're a little bit more pessimistic about the global outlook. And I'm struck by the fact that I think sentiment's actually still relatively positive here.
Inez Ferre has you for the next hour of trading. Stick with us as Rochelle, we're continuing to watch these major averages closely, and they are in the red. And later on today, after the close, Apple earnings, everyone. Stay tuned. We've got much more Yahoo Finance Live coming your way.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Ines Ferre. Here's what I'm watching. Investors head to the exit. PacWest confirms it's evaluating all options, including a sale. We'll look at the group's footprint and why U.S. regional banks are the talk of the town for all the wrong reasons. Beyond COVID, Moderna's CEO Stéphane Bancel joins to talk results and all things mRNA. Shares in the pharma and biotech business haven't had a good run this year, but there's positives in the numbers. Don't miss that. And on the up, Shake Shack shares jumped as it tops revenue estimates amid solid football and new store openings. Is the group's era of fine dining giving it an edge? We take a deeper dive this hour. But first, let's check on the major averages. We are seeing all major averages lower. The Dow right now down more than 330 points or 1%. The Nasdaq is down about 0.5%. And the S&P 500 is down 0.7%. Taking a look at the Treasury market right now, we are watching the 5-year note that's down, and that's at 3.27%. The 10-year yield also down as well by about 8 basis points, and the 30-year yield is down by about 3 basis points. Another domino could potentially fall in what has been a testing time for the financial sector. Here with the details is Yahoo Finance's Akiko Fujita. Akiko.
Good morning to you, Inez. Well, after the failures of early March, banks have been on high alert over the state of the financial sector and specifically the so-called regionals. And that is what we're talking about this morning. It all, of course, began with the collapse of Silicon Valley Bank earlier this year. They, of course, were a key lender to the tech startup community. The Fed has been given some of the blame for starting the turmoil by raising rates high and fast. SVB was largely hit by interest rate risk. Essentially, when bond yields go up, the value of the bonds fall, and they were sitting on a lot of them. That's the story with SVB. Now, earlier this week, First Republic became the second largest bank to fall as the contagion grew and its deposits slumped. And this morning, PacWest Bancorp is apparently on the chopping block. Shares plummeting. You see it down more than 50% here following confirmation of a Bloomberg report that it was weighing strategic options, including a sale. Now, PacWest looking to get out ahead of the messaging here to ease some of the jitters in the market, saying in a statement that the bank has not experienced deposit flows that are out of the ordinary, adding that the bank's cash and available liquidity, in their words, remains solid and exceed uninsured deposits. We've also heard from the company as well, trying to sort of ease some of those concerns. Now, analysts were quick to take action as D.A. Davidson downgraded the stock to neutral. Meanwhile, other regional bank names are also falling to the red as PacWest reignites banking fears. One of the ones we're watching specifically is Western Alliance. Shares there halted in the session. You saw it take steep cuts earlier in the week. And we have also heard from Western Alliance reportedly saying that a report of a deal is absolutely false, specifically as it relates to that bank. Now, signs of worry over PacWest Bancorp came shortly after Federal Reserve Chairman Jerome Powell reassured Americans in a press conference just yesterday on the soundness of the U.S. banking system. Take a listen.
The U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
Now, despite those comments from Jay Powell, in light of the new stress point that is PacWest, Pershing Square Capital Management CEO Bill Ackman is now sounding off on a warning on regional banks, saying, quote, banking is a confidence game. At this rate, no regional bank can survive bad news or bad data as a stock price plunge inevitably follows. Insured and uninsured deposits are withdrawn, and pursuing strategic alternatives means an FDIC shutdown over the weekend or over the coming weekend. No doubt regulators will be keeping a close eye as Michael Barr, the vice chairman of the supervision of the Fed, along with the FDIC chair, Martin Gruenberg, are scheduled to testify later this month on those bank failures. Inez?
Yeah, Kiko, and it's interesting. I mean, you mentioned Bill Ackman, also ARK Invest CEO Cathie Wood, just saying in an interview that she thinks that this banking contagion is accelerating. I mean, look, the markets seem to also think that as well. We saw a lot of pressure on the regional banks earlier this week, and we saw the comments that Jamie Dimon said. We saw the comments that we have spoken to analysts also that have said, okay, well, this seems to be contained right now. But obviously, the market's thinking differently.
Yeah, it's been interesting to see just the diversion in terms of comments coming. The big banks, you mentioned Jamie Dimon. We also heard from Citi's Jane Fraser earlier this week saying that, look, the fact that big banks are able to step in, the fact that they are able to step in and essentially rescue some of these regional banks points to the fact that this is not a repeat of 2008. That's not what's going on right now. At the same time, Inez, I know you've been talking about this a lot as well, but since SVB, there's been a lot of conversation about how rapidly these things could really pick up, partly because of digital banking, partly because of social media. Things are happening at a very quick pace right now. The minute somebody hears that potentially one bank could be on the chopping block, there could be some concerns about deposit outflows, that tends to get accelerated really quickly. Again, worth noting, though, the focus has been on the regional banks, not the big banks. But of course, you look at the market and how it's responded, big concern right now about who could be next to fall.
Yeah, and we have seen that divergence between the regionals and the big banks. The regionals, much more pressure on those shares as well. Thanks so much, Akiko. And from bank failures to rising rates and a looming recession, it's been a whirlwind of commotion thus far in 2023. Here to help shed some light on the potential portfolio moves as investors navigate a slew of market risks, we have PIMCO Managing Director and Portfolio Manager, Sonali Pierre. Sonali, we've seen the shorter term bond yields movements in the last few days, especially given the banking crisis pressure, and we've seen on the regional banks. I'll pose this question to you. Do you think that we have seen the last of the woes for the regional banking sector?
This has been a really difficult time as rates have risen quite steeply and quickly. And what we're seeing is really a digestion of that move. And often these types of moves take time. And so, while it may not, I would say that while the Fed is now likely to pause after yesterday's rate hike, we are still in a period of adjusting to the higher level of rates. And that's essentially what's plaguing these regional banks. But overall, I would reiterate that, this is very different than the great financial crisis, especially as, regional banks have smaller asset bases. And even with respect to the investment grade corporate bond market, they make up about 1.8%.
Yeah, I mean, and just looking at also the aspect of outflows, deposit outflows, and I mean, I'm just taking a look at some of the Treasury yields right now. Looking at the 3-month bill, you're looking at a yield of 5.2%. So why would anyone want to keep their money in a savings account if they can go to the Treasury, to U.S. Treasury, and just buy some bonds there with high yields?
That is part of the difficulty in today's environment. It's not necessarily just concern around some of these banks, but it's also that you can get a much better yield by investing. It is certainly the case, even in a low duration product such as the one you mentioned, that there's real income that you can generate. Yeah, and that's part of what our discussion internally around bonds are back. It's hard to ignore that level of yield and income, even with some potential for volatility ahead that can be generated, especially from fixed income products today.
So where should investors be positioning when it comes to bonds?
Thank you. I would say that, a diversified opportunity set in fixed income and high quality credit can be very attractive, especially for a longer term hold, given low potential for default loss and decent income today, and really realizing that in today's environment, with while there could be some spread volatility ahead, we still see potential for positive expected returns for the year.
And as far as Fed Chair Jerome Powell yesterday and the Fed raising rates to 25 basis points, what do you see ahead? What do you think that the Fed may do in the future? I mean, it does seem like that the rate hikes are over, but what do you think?
Yeah, I would just, to thread the needle, I would just highlight that a pause is not necessarily the same as stopping. I think they really built in some optionality with a statement yesterday, really highlighting that, okay, we've done 25 basis points. We've removed that. We think that there would be some rate hikes ahead and really kind of built themselves the chance to, be data dependent and continue to tackle inflation. Although, while inflation's been sticky, so has employment. And so they still have some room if needed. But at the same time, they're clearly looking at some of the stress in the regional banks and being more cautious with the outlook in terms of timing of next moves.
Thank you so much, PIMCO Portfolio Manager Sonali Pierre. Thanks. And shares of First Horizon take a plunge after calling off their previously announced merger agreement with TD Bank. The mutual agreement to terminate this potential deal came after TD informed First Horizon it did not have a timetable for regulatory approvals, thus due to uncertain nature as when and if these regulatory approvals could be obtained. Both parties decided to part ways. Coming up, shiny happy people. Well, maybe not everyone. We speak with an asset management big hitter on keeping it real amid economic risks and a shaky financial sector. More from Milken next. Let's do a quick check of the market sponsored by Flex Shares. We're watching all major averages lower, with the Dow down about 250 points off the lows of the session. The Nasdaq Composite is down 0.1%, and the S&P 500 down about 0.4%. Financial stocks are underperforming today. The mood at this year's Milken Conference has been largely optimistic, but our executive editor Brian Sozzi sat down with TCW CEO Katie Koch, who said the positivity might be overstated.
One of my main takeaways is that people look a little too happy for me here. We're a little bit more pessimistic about the global outlook, and I'm struck by the fact that I think sentiment's actually still relatively positive here. We're really looking at TCW for a macro environment that's going to be pretty challenging, and so we're in the camp of having a medium to hard landing. And what I would say is that I don't think the rest of the sentiment's caught up to that view, and that makes sense because in the markets we can see a relatively sanguine expression that credit spreads haven't widened yet. We haven't seen the VIX broaden out a lot, and so my main message to you would be that our outlook is more negative going forward than probably consensus, and more people need to catch up with us, which means that we're probably going to have more volatility and more drawdowns ahead of us.
Thank you for keeping it real, because that has been one of my takeaways so far from the conference. But on the positivity aspect, what is driving that?
Our outlook, what's driving our outlook?
Well, why is everyone still so positive on markets when they see a lot of train wrecks coming right at them?
Yeah, no, that's a good question. I mean, I think the main reason for that is that it's kind of correlated to the fact that the markets haven't really started to correct aggressively yet, number one. And number two, people understand that the Fed now has firepower to cut if they need to support markets. And I think that gives people a kind of sense of confidence that things could be okay.
Do you see a rolling credit crisis? And I ask that because a lot of folks that I've talked to at the conference worried about commercial real estate, worried about the aftershocks of all these rate hikes we have had. Do you share that sentiment?
I am worried about the environment from that perspective. I mean, usually recessions are preceded by some type of credit incident. Obviously, in the last big one, that was around mortgages, and in particular residential mortgages, and then how that created systemic risk in the banking system. This one's going to look different because that was about large banks, and this one obviously is much more focused in the small and regional bank space. But people shouldn't be mistaken that somehow makes it less severe in any way. Actually, small and regional banks are very big contributors to the economy and to jobs. Just you may be aware, but about 50% of Americans are employed by small businesses. Contributes about 50% to GDP, small businesses do. And when you look at companies with 100 or fewer employees, 70% of their commercial and industrial financing comes from small and regional banks, and 30% of such financing, so small and regional banks with 250 billion or less in deposits, and 30% of such financing comes from small and regional banks with about $10 billion or less in deposits. And so the main issue is that those banks are suffering deposit outflow. Obviously, that's been reported widely in markets. And the other issue is what you pointed to around commercial real estate. These banks are actually very large holders of commercial real estate that used to be owned by big banks. It's now owned by small and regional banks, insurance companies, and some private market players. And so they have this dual pressure from both deposit outflow and their commercial real estate exposure, and that's going to put pressure on those banks. It's going to put pressure on their ability to extend credit, which in turn is going to put pressure on the economy and jobs. And so, yeah, we are quite worried about that, and that really underscores the base view as to why we're in the more bearish camp.
What ends this crisis? Is it a crisis?
I don't think we'll get to a crisis. I mean, we're going to have a recession, and just to make people feel calm about that, recessions have human impacts, and we need to acknowledge that. It's job loss, and that's obviously a very bad thing. But we also need to acknowledge that the world always moves in cycles. We've actually been in a very long expansion cycle with a short blip when we were talking to each other from our respective kitchens. But other than that, we've had a 15-year expansion. And the world does move in cycles. We are likely to head into a recession for that reason, and because we've had a lot of excess buildup. We're going to need to work our way out of it. But what I would say to you on whether or not it's a crisis is going back to the fact that the big banks, that what we call the GSIBs, the globally systemic important investment banks, those are actually highly well capitalized. And all of the regulation that we put in place in the last crisis actually should put them into a position to be able to act counter-cyclically to deal with whatever credit crunch comes. So I want to say that yes, there's a lot of pressure in small and regional banks. it will be the catalyst, that credit crunch for this recession. But the world does move in cycles. It doesn't necessarily have to turn into a full-blown crisis. We'll have a slowdown in the economy, and hopefully we'll be able to address that slowdown through a combination of Fed action as well as counter-cyclical credit extension from the big banks.
And that was TCW CEO Katie Koch along with Yahoo Finance Executive Editor Brian Sazi. And in cruise control, Royal Caribbean boosts its full-year guidance on some strong numbers. The CEO saying demand well above historical trends. Are things really that good? We'll ask its CFO next. Sailing into the summer, Royal Caribbean cruises rising on booking volumes as customers gear up for the summer. The cruise operator hoping for big spenders among those customers, even as recession fears loom. Joining us now, Naftali Holtz, Royal Caribbean Cruises Chief Financial Officer. Naftali, thanks so much for joining us. The street really liking these results. Booking volumes up considerably from the same quarter in 2019 and a full year earnings guidance raise. What do you attribute all this to?
Yeah, first, great to be here again with you. As you said, we are very happy with the results that we announced today. We continue to see very strong demand for leisure travel and for our cruise experiences. And it's a combination of a very attractive value proposition of cruise, the shift in preferences from our consumers to spend more on experiences, and we are well into the experience bucket, and our culture of innovation and performance that are driving the results.
Can you give us a little bit more of a backdrop regarding the consumer that wants to spend on experiences? Because we've heard this over and over about consumers spending more on services perhaps than on goods. So give us a backdrop on what is that traveler like? Where does that travel? Are there some routes that the traveler prefers over others?
Yeah, so we see a very broad range of excitement and demand across our products. We appeal to a very broad consumer base, and they seek everything, all the way from, this Oasis of the Class ship that I am on today from the Royal Caribbean International brand is going to cruise the Caribbean with a visit in our amazing private island, perfect day at Coca-Cola. So it could be a short Caribbean itinerary, a longer vacation, or even a world cruise or a trip to Europe this summer. We have seen a very broad-based demand. The Caribbeans are especially very strong. And we see very, very strong demands for that. And that's a combination of what we are putting out there in terms of our experiences and products, the best ships, the best experiences, and the best destinations.
Now, we've seen recently this banking turmoil. There's a lot of market participants that are basically calling for a recession this year. I know that the cruise travelers are very loyal when it comes to their cruises, but how elastic is the customer really if there is a recession?
Yeah, we continue to see, as I said, very strong demand. It translates to us doubling our revenue yield guidance for the year and earnings increase of over 40%. And I think the combination of the secular demand that I was talking about, the fact that cruise is an exceptional value proposition compared to any other land vacation alternatives, we think we can close the gap to it. But that is a very compelling for the consumer, and just the strength of our platform. So we continue to see very strong demand. We do not see any cracks in the consumer, and we are very, very focused on making sure we deliver on that experience. And as we look forward, that is what we're seeing. And if you kind of look a little bit longer term, cruise has been exceptionally well, even in very different economic environment. So we're very excited about what's ahead.
Can you talk to us a little bit about cost? Because we have seen energy prices coming down. Is that a tailwind for you?
Yes, of course, fuel prices are a big component of our cost base. We are very focused on making sure that we are optimizing our consumption of fuel. We do hedge some of the fuel rates, so we have 50% hedge for the year. So we do, have an opportunity to enjoy from lower fuel prices, and our focus is on growing the revenue and growing margins. So controlling the costs and making sure that we expand margin.
And talk to us a little bit about labor as well. Has it been difficult at all to get staff? Is it easier now because we have seen a little bit of a slowdown when it comes to the labor market, even though it's still tight?
Yeah, so our crew members, which is where the majority of our human capital has been so delighted to come back over the last couple of months back to doing what they do best and they love, which is deliver the best vacations responsibly. So if you get on the ships and you see them, they're all smiling, the guests are smiling, and that is really what they're focused on. So we didn't have any issues. We really had very strong demand to come back to those. We do see some more difficulty in our headquarters and shoreside, but this company is exceptional, and we see a lot of demand coming to work for us.
And shares of Royal Caribbean are up almost 8% right now. Naftali Holtz, thanks so much for joining us, Royal Caribbean Cruises Chief Financial Officer. And turning now to fresh and hot earnings from the food industry. Shake Shack doubling down on its play for the high end. The quick service restaurant saying in its earnings call that it wants to aim for the luxury consumer, even as fears of tightening spending continue to grow. Here with more, Yahoo Finance's Brooke DePalma. So Brooke, the luxury consumer at Shake Shack.
The luxury consumer apparently spending a lot of money at Shake Shack, and investors seem to be, maybe another food company, but loving it. I mean, shares this morning were up more than 15% after Shake Shack reported its quarterly earnings results. And if you take a closer look, similar to what we're seeing across the fast food industry, same-store sales continue to increase for restaurant chains. As you can see right here, higher than Wall Street estimates, up 10.3%. That's higher than nearly 9% like Wall Street had anticipated. And what really is driving that is consumers looking to get out, looking to spend, and even some trade down that we're seeing of consumers coming to Shake Shack to get more bang for their buck, perhaps, as they remain pinched in this inflationary environment. But taking a closer look at some highlights that we heard in the call. Unfortunately for Shake Shack, higher costs still do persist when it comes to the cost of beef. They expect that to rise mid to high single digit. Also something that we haven't really heard a lot yet, but fries expected to cost about 20% more compared to last year. In addition to that, they're also seeing paper costs and food costs. They were 29.4% of Shake Shack sales this past quarter, but consumers going back to those pre-COVID behaviors. They're going to more Shake Shacks, they're dining in person, and they're even using kiosks more, which Shake Shack is investing heavily in, and those tend to help boost sales for Shake Shack. I guess too many consumers don't really want to say, hey, I'll actually get that extra milkshake. But if it's on the kiosk, they have no problem saying that. But they're also saying that that in-person dining trend is helping packaging costs a little bit there. And as Inez mentioned at the top of this, that healthier behavior among high-income consumers. Foot traffic certainly also got a boost, and what they said was the limited time white truffle promotion. Now that also was a higher cost. That was $8.99, and it saw high income consumers trade into the category. Here's what the CFO had to say about that on the call.
We over-indexed to higher income consumers. We were really encouraged by that 4.8% traffic we generated in the first quarter. And, you know, we have to just really kind of talk about white truffle was the most expensive LTO that we've ever launched. We're kind of that attainable luxury. We're definitely gaining share at the high end. And, you know, we hope that that continues.
And for their fiscal year guidance, they do still expect same Shack sales, as they call it, their same store sales essentially, to increase low single digits to mid single digits. But they did emphasize that they are weary and they understand that macroeconomic risks that may further impact the restaurant sector and those upcoming results, just to be mindful of how that consumer might change, how their spending habits might change, and more oncoming challenges that might face the consumer in the coming year. So certainly an optimistic take from Shake Shack here, and even from Wall Street we're seeing as well.
Yeah, I know those shroom burgers, you can't really beat those, although they are costing close to $9. So.
Right, now they just added more to their vegetarian menu as well, so certainly looking to engage more customers too.
Yeah, now the company is looking at expansion plans and also drive-thrus. Talk to us about that.
Yeah, well, Shake Shack, I feel like, is largely known as sort of a New York metro-based restaurant chain, that roadside burger chain, but they have big plans for international operations as well as license operation. They said that the license openings, they plan 30 to 35 in 2023, domestically approximately 40, and they're heavily committing to drive-through. They weren't able to share too much about what sort of consumer behavior that they see in drive-through, but they did say that it was a big opportunity for them. They're set to add another 15 and more than double the size of their drive-through template this year. And so there's lots of opportunity for the company to learn about the behaviors that they expect when it comes to drive-through. But the past quarter, they opened 13, 6 operated, 1 drive-through, and 7 operated by licensed partners. And so certainly a big learning opportunity in terms of just sort of international growth and how you could see this New York-based chain sort of make it global.
Yeah, I mean, and also even in the suburbs, I mean, that's where I live in. I'll tell you that it would save having to park the car, go in, pick up the package. Drive-through would be much easier. Thanks so much, Britt DePalma. And coming up, Apple's product division expected to underwhelm investors today as results hit after the bell, but big moves on dividends and buybacks will get them smiling again. We look to that report next. Two big stories we're watching this week, results for Apple and Berkshire Hathaway's AGM, the latter coming at a crucial time amid banking upheaval. Let's kill two birds with one stone, though. Apple is now Berkshire's biggest holding. So what happened since Buffett bought into it? Here is Yahoo Finance's Josh Schaefer. Josh.
So Berkshire Hathaway first bought Apple stock in 2016. And if you followed the Oracle of Omaha and invested $10,000 when Buffett first bought Apple, you'd now have almost $70,000. So Buffett missed the launch of the iPhone and the ensuing product boom in Cupertino, but instead he's ridden the most recent wave of Apple's growth, driven by revenue boosts in services and wearables. Those segments have grown roughly 300% since Buffett first bought. Berkshire's purchase came the year Apple launched AirPods. Then in 2019, Apple introduced both its Apple Card and Apple TV Plus. Those kinds of services have helped bring customers further into the Apple ecosystem, a concept Buffett is bullish on. It hasn't all been rosy for Buffett. He sold some shares prior to the annual meeting in 2021. And in 2022, production of the iPhone was cut short by unrest at Apple's factory in China. But the Oracle seems poised to ride along Apple's next leg of growth as the tech titan opened its first store in India and just launched a high-yield savings account with Goldman Sachs last month. He may even benefit from what could be Apple's biggest product yet, as all eyes are now on a rumored AR headset potentially launching later this year.
Josh Schaefer, thank you so much for joining us. And moving on now, knowing that Buffett is a big fan of Apple, is it the right move for your portfolio too? Joining me now to discuss is Francisco Bido of FM Investments, head of quantitative research portfolio manager. Francisco, I know that you hold Apple long term, so does Berkshire. But let's start out with, what do you think that Berkshire sees in Apple?
Well, I think we both see the same thing. We see a great company with, basically a really foothold, more than a foothold, a stronghold on the consumer wearables market and on the communications with the iPhone. And those things will be critical, for going forward. It's hard to imagine, any kind of technological progress, that's more impactful than what Apple brings to the consumer. So I think that's going to continue for the long term.
And Apple will be reporting after the close. So what will you be watching for in those results?
Earnings, both bottom and top line. And that's what we focus here with our strategies. We like to look at accelerating earnings and revenues. We don't have high expectations for Apple for this quarter, for the quarter they're reporting. We expect to be a little bit underwhelmed, but we still don't mind holding it long term. It's just that when you have a long-term view, these little bumps on the road, they're fairly inconsequential.
And let's talk a little bit about those little bumps on the road. I mean, we've seen what's been happening with the markets. We have been watching the consumer closely. What do you think are some of the challenges in the near term for Apple?
Well, it's just basically the economic environment. As we know from yesterday, the Fed raised another 25 beeps. That's the 10th time since last year, and that's beginning to pinch the U.S. economy. So, we expect the consumers to continue to pull back on discretionary spending. If they have a phone that works, they're not going to probably update very quickly to the newer phone. So that's a short-term challenge for Apple, and for not just them. It's pretty much anyone. It affects everybody in equal ways. However, I would like to point out that I'm not expecting a recession or anything of that nature, not with so many people working.
Oh, interesting. So you are not expecting a slowdown or a recession?
No, I'm not. No, I'm not. I think we're going to weather this, and I think the Fed's soft landing scenario, that Goldilocks scenario, is still very much in play. I think we can get inflation a little further down, and the labor markets are still probably going to hold their ground.
And you think the Fed's going to hold rates as is? They're not going to hike anymore and hold for how long? And what will that have? And how much of an impact will that have on the markets?
Oh, I think the farmers market. I think the market needs confirmation. Are they really stopping, or what's going on? I think my impression from yesterday's meeting is that they will let the lag effects take a hold, which I think is the right move, and just be patient. So with that said, I'm expecting yesterday's move to be the last one for a while unless we see inflation all of a sudden spiking up, and I don't see that happening.
Coming back to Berkshire and Apple, when you take a look at both of these companies, which do you think is the better choice? I mean, would you be an investor in Apple? Or I know that you are, but do you recommend that investors look at just Apple, or do you recommend that they look at a company like Berkshire, which holds many other companies as well?
Right, that's a good question. And for that, I have for that one. So number one, it depends on the kind of investor. So if you're a bit more aggressive as an investor and don't mind a bumpy ride, I would say go with Apple. You know, Apple is there for the long term, and I think they'll do fantastic long term. Short, if you are a more conservative investment who doesn't enjoy the roller coasters, then you should stick with Berkshire Hathaway. Just go that route. I think they're excellent choices, but I would distinguish them in that sense, you know, depending on investors' appetite for risk.
And some of these companies, Berkshire and Apple, they are sitting on a lot of cash. I mean, how do you see them spending that cash?
Well, in case of Apple, I think that cash should, maybe they'll better off returning some of that to the shareholders, you know, in terms of increasing their dividend. We'll see. You know, that's a way to definitely tackle any kind of economic slowdown, a temporary one at least, and something they can definitely manage and pull through.
And you are bullish on Apple and on the economy as well. Thank you so much, Francisco Bito, FM Investments Head of Quantitative Research Portfolio Manager. And our coverage ahead of Berkshire's shareholder meeting continues this afternoon. We're looking at some of Buffett's investment mistakes and how you can avoid them. Next up, beyond COVID, we'll hear from Moderna's CEO Stefan Bancel on a changing landscape for the group and a big push into mRNA therapeutics. Don't miss that conversation next. A new GlaxoSmithKline vaccine is approved to fight a lung illness called RSV. That go-ahead from the Food and Drug Administration, opening the doors for the drug maker to seek approval worldwide. Here with more on the medical space, Yahoo Finance's Anjali Kamlani. Anjali.
That's right, Inez. So GSK's new RSV vaccine is the first approved for the disease worldwide, and that's a really big move for the company. That's why you can see the stock getting a boost from that as of yesterday when the FDA gave the green light. Now, this vaccine showed 82% efficacy in phase 3 trials, and that's important because it is for older adults. That's anyone ages 60 and older. Now, there are 3 different groups that this virus affects, and that is younger kids. So you're looking at, the under 2 group typically do get this virus, as well as the older population. There's also a vaccine in the works by Pfizer for the older age group. They're expected to get their approval sometime later this month. And then Moderna is also in on it with one of their own candidates for the older age group. Pfizer also has one for the maternal population that is set to get approval sometime later this year. So you're looking at 2 vaccines launching this year for this space. Really big news because this has been an area that has been lagging and needing a vaccine for over 60 years. So really big news in that space. Turning now to earnings in the health space, Moderna gets a booster shot. Moderna continues its climb as strong sales of its COVID-19 vaccine give the drug makers earning a shot to the arm, pun intended there. The company hoping the news will turn around its stock battered by the long-term diagnosis of fading demand for their COVID-related products as the pandemic wanes, and leadership citing a lot of unknowns in the future, with the company putting bets on research and development, hoping to score with flu shots, personalized cancer vaccines, and as we mentioned, RSV. Joining us to talk about his company's earnings, Stéphane Bancel, Moderna Chief Executive Officer. Stéphane, great to speak with you again. I know that this was a surprisingly strong quarter for some. Talk to us a little bit about that with the COVID demand and what you see through the rest of the year for COVID specifically.
Well, good morning, and thank you for having me back. I'm very happy about the quarter, and even more happy as the company is firing on every cylinder, both commercial and R&D. So on the commercial side, I think people have too quickly assumed that COVID is gone. The virus is not leaving the planet, as you know well, and people at high risk still getting hospitalized, still dying. Every government we're talking to is getting ready for the fall of 23 in terms of ordering products. And so, we said the minimum of sales from contracts signed last year with $1.9 billion of revenues for Q1. So we are well on our way. And I'm very pleased about the progress the team is making in the US. Those are all new contracts on top of the $5 billion with pharmacies, government agencies, hospital networks. What's happening in Japan, what's happening in Europe, also in the rest of Asia, Middle East, and Africa. And so I think people have too quickly concluded that COVID sales are going to zero. They're not. COVID is going to be with us forever. It is true that 23 might be a down year because of all the products purchased in 22. But I really think we're going to see that as the bottom year. 24, I think we'll have higher COVID sales. And then excitingly, as you mentioned, RSV is on track to be launched in 24. Flu is on track to be launched in 24. The combination of COVID and flu for 25, with also great data in the coming weeks in terms of cancer vaccine. We announced last night rare disease, new data coming in 2 weeks at a big rare disease conference. So the company is really firing on every cylinders.
Yeah, you jumped ahead of me there. I'm going to get to flu and RSV in a second, but talk to me a little bit more about the COVID outlook, because I know that you definitely see it not going away. You have also some combo vaccines in the works. But to your point, considering that it's not going to be the same revenue as you saw, of course, during the start of the pandemic, what are you expecting moving forward, especially considering that you don't have any near-term launches just yet?
So I think what we're going to see in 23 this year is sales in excess of $5 billion. Again, we want to be cautious. $5 billion, we see it as a floor of deal already signed. But this assumes no sales from the US, no new sales from Japan, and no new sales from Europe and many other countries. So as we are contracting in the coming weeks and months, I think we'll be able in a position to kind of give a bit more visibility. But because no company has ever managed from a pandemic to an endemic setting, we want to be cautious. We don't want to disappoint. And so you see us being very cautious on the top line, and we'll give more information as those contracts are signed. But from what I see, from the discussions happening with countries, discussions happening with private clients in the US, I feel very positive about the current momentum.
Definitely. So talk to me about RSV, because I know you're trailing in that sort of race, if you will, with the 2024 launch when your rivals are looking at this year. Do you expect to still compete well in the market, or do you imagine a smaller share of the market as a result?
So it's a good question. So first, for context, we started developing that vaccine 6 years after the two other companies. So I think the mRNA platform was allowing us to really catch up. And this happened while the team, which was still small, was focused on COVID. So just for context, I think being just a little bit behind those two other companies is a pretty big achievement. In terms of products, if you look at the efficacy data, especially what we showed at recent medical congress, is in the older population and people with comorbidity, our efficacy is really best in class. And so I think that's going to help a lot, because at the end of the day, doctors and consumer wants the best product. The other piece is going to be the ease of use of a product. Some of our product come in lyophilized form. What is that? It's powder in a little vial that has to be prepared in a pharmacy for every patient. That is not fun in a world where there is not enough workers, where pharmacy chains are reducing the number of hours open because they are lacking pharmacists. Our product will come in a pre-filled syringe. So a pharmacist will directly take the product out of the fridge and just clean the arm and inject it. No prep work. I think that's going to be important. The other piece too is the safety profile. As we all know, for vaccine, safety is really important. We have announced this morning that we still have no cases reported of Guillain-Barré syndrome. And that's really important because the safety profile of vaccine is key. So when I look at the very high efficacy in elderly with comorbidity, when I think of the safety profile, when I think about the ease of use, I believe we actually might have the best vaccine. So we might be a bit behind, but we might catch up pretty quickly.
And let's talk about flu, because I know you have the combo set to possibly debut in 2025. But I think that's one of the reasons why investors are sort of lukewarm on the stock right now, talking about, you know, a longer term look at launches and the pipeline. Do you think that the pandemic really took time away from the production that you have and the development that you have, and you're sort of making up for lost time right now?
For sure, the pandemic slowed us down. You know, when we showed the cancer data in December, I mentioned that we lost at least a year in getting that beautiful data that I hope will help a lot of people with cancer, because we had to slow down the recruitment of the cancer clinical study. So now we're kind of doubling down to catch up, and the data are very, very strong. We announced this morning that we'll show even more data for more biomarker at ASCO, which is just a month away. So we lost a bit of time, you know, helping the world get rid of this virus, getting back to a normal life. But what also the pandemic has done is, by validating the technology, by providing huge financial resources to Moderna. I mean, think about it. We announced this morning we still have $16.4 billion of cash. So this platform that we built for 10 years before the pandemic is coming to nature. We have so many respiratory vaccines, as we spoke about. We have a latent vaccine like CMV, EBV for mononucleosis, and so on. We announced recently a Lyme disease vaccine, and then cancer, and then rare disease, where the data is looking also very strong. So I think people, as you know, in this industry, investors value the pipeline. They value sales, obviously, but they value the pipeline. And if you look at Moderna in terms of 24 launch, 25 launch, and even more launches in 26, I think it's going to be unprecedented. And the other piece too is the success rate. As you know, in pharma, 90% of the drugs getting into the clinic fail. Look at Moderna, the COVID-19 vaccine. We did the best-in-class vaccine in 9 months, and then RSV, and then flu, and then the cancer data. There has been hundreds of cancer vaccines tried over the last 2 to 3 decades. Not one has worked. The Moderna one is working beautifully. And we think it's not only working in melanoma, but also in lung and other cancer types. And then now rare disease. There's not one rare disease. There are dozens of rare disease in the liver. This is the first technology we're using is for PA, or first rare disease. But what we'll do is to scale up, you know, many, many drugs in rare disease like we did in vaccine, because we have a platform. So we have a platform with very high success rate and with a lot of capital. So I think investors are starting to really see what's coming.
Certainly. Well, Stefan, really looking forward to see what you have set up for the rest of the year. And thank you again for joining us today. Moderna CEO Stefan Bancel.
Thank you.
Inez, back to you.
And let's take a look at the markets right now, where we're at. We're looking at financial stocks which are dragging on the major averages. The Dow is down right now, down more than 1%. The S&P 500 is down as well, almost 1%. And the Nasdaq Composite losing the least, down 0.6%. That's it for now. I'm Ines Ferre. Thanks for watching.